Okay, folks, if you guys would be so kind, give me a audio check confirmation on Twitter, please. Echo Bravo. Thank you for that. Okay, I do believe I figured out why we were always losing audio on our live sessions. And I went out and bought myself a new mic and all that, thinking it was um, limited to hardware. While I did have a failing mic before, my software program that I'm using, I have it set up as a hotkey. And the hang on one second. The platform that I use to share and live stream with, they allow you to set up hotkeys. So that way, if I want to mute, I hit a certain key, I program it as that's my mute button, and I have it set as a space bar, which unfortunately is the same way I toggle through PowerPoint displays. I hit the space bar. So today we're going to be doing something a little differently. I'm going to be using the page down key to transition from one slide to the next. So we're going to be able to redo the presentation we had last night, and we'll do some further commentary that I wasn't able to include last night. Okay. I'm seeing a lot of you guys say the volume's low. The microphone is all the way up on the settings, and I'm actually talking louder than I usually do. So I'm not sure how I can overcome that. I don't want to scream at you the entire time because I'm already raspy as it is. Alright, so let's take a look at our teaching. Okay, and I just want to confirm audio one more time before we begin. One more audio check, please. Thank you very much. Alright, so we are going to cover intraday price templates. Now, the template is more or less like a roadmap or a thought process that goes through my mind based on what the price delivery is going to be for that particular day. Now, the central bank is the one that sets uh, the pricing. Okay, when we have trading, for instance, for folks that are trading in FXCM or Oanda, okay, or any other brokerage firm that you may trade within. If you're not trading through a prime broker, you're trading through a derivative of the price feeds that are offered on the interbank market. Some brokerage firms will claim they have the actual the same feeds that are being tossed between the banks. I'm not going to argue about the validity of that because frankly I couldn't prove it one way or the other, but I can tell you just looking at the platforms that are available in the retail world, you're going to see a disparity between highs and lows. No matter what time frame you're looking at, they're never going to agree on the exact price. So to me, um, you're going to have to allow some certain um, gray area in these templates, and I failed to mention that last night. But overall, there is 6 general templates that Price Action uses on creating, or as I teach it, engineering the daily range. Now, the daily range is the open, high, low, and close on a daily chart. Okay, so if you're going to be a day trader, the premise is you want to try to capture, hopefully, the direction of the move for that particular day. If it's a bullish day, which this teaching, like we were doing last night before the audio issues plagued me, we're focusing primarily on the buy side only. Now, before you get scared and thinking I'm trying to hold something back, it's just for time's sake. Everything that I teach, if you reverse every individual template, just if you go into, like for instance, if you go into MS Paint on your computer, okay, you can take these templates and just invert them. In other words, just reverse the image, and that's what you'll have for the sell scenario, okay? But the idea is stay on one side of the marketplace, learn the templates, okay, and study them. So everything I'm going to share with you here today, like we did last night, but you missed some of the audio, you're going to be able to go in your own charts and study for at least 30 days. Go back over the last 4 weeks, go over the entire month of March, okay, and pick one currency pair. And based on what I'm sharing here in this presentation, I want you to classify and label basically the price action that took place each individual day. Every single trading day will fit one of these 6 criteria. Okay, there's always an application of one of these 6 to any market condition. Now, that doesn't give you show me when to get in. Okay, so if you're here to learn show me when to get in, the template is only going to be an aid to you understanding, or as I use it, it helps you anticipate what the daily range may unfold. In other words, what is the probability of certain characteristics of this individual day? What phenomenon should take place, and when should it take place? And here's an important thing: why it should take place. Okay, it's not enough to understand that the market should go higher, but think about it. I mean, folks can be bullish on euro. They believe euro is going to go higher against the dollar. So just because they have that premise that they're bullish on the fiber, does that equate to them actually finding entries to get in and be long? If you're a new trader, you know what I'm talking about. You're probably struggling there. You got an inclination or a feeling, okay, that this pair is going to go higher, but you don't know how to get in. So these templates are going to help you formulate an idea based on context of the marketplace, which is what we're going to talk about individually as each template is shared. So I'll spend a little bit more time than I was unable to do last night, and give you some insights on when to anticipate the individual price templates that we use for day trading models. But they're not limited to just day trading. So while they are primarily aimed at giving you a greater understanding on how the central banks formulate the daily range, and yes, in my opinion, they are absolutely predetermined. In other words, they know it's going to be a higher close before the market even starts trading, and they, as the central bank, think about it. When you trade, and you're trading through a retail brokerage firm, who's the market maker for you? Who provides that marketplace for you to trade? The liquidity pool provider that you trade within, the house, okay, or FXCM or Oanda, okay. But they get their pricing from the central bank. So really, who's the market maker? The central bank. So I understand there's a lot of things that we can study and I teach that are limited to retail focused principles. But you have to go beyond that and go beyond institutional view and go right to the source, which is the central bank. Because the central bank is a storehouse, they're controlling the overall price model that creates the daily range. Yes, there's going to be short-term static that's generated because of news releases. It could be a geopolitical event around the world, a war event, a terrorist attack. Any one of these types of things can cause a short-term blip in intraday price action. Anything can happen. But generally, you'll see that the models that I'm sharing today are pretty generic, which is great because you want your trading to be boring. You want it to be monotonous. And by having these ideas and understandings, you'll be able to frame a better perspective on your trades and be able to focus in on high odds probabilities. And you will, here's the big takeaway: you won't have so much uncertainty and fear and trepidation about taking trades, and more importantly, holding on to them, because day trading is not scalping, 10 or 15 points and thinking you've conquered the world. I'm smashing, I'm killing it. Can you make a lot of money parlaying your money up with doing that consistently? Sure, you can. But I'm targeting an audience that A is new to trading, or they're struggling, or they are hit and miss. Okay, that's what this is helping. Those that know my work, this will actually um, build a greater understanding and clarity to price action trading. So in other words, this is kind of like one of those um, secret recipes, if you will, on how I'm able to determine what the daily range is going to be. I mean, you've seen over the years where I've called highs and lows in the marketplace right to the pip, right to the pip. And while a lot of people can claim they do things similarly because they have an understanding in either indicators or other principles in technical analysis, my stuff is pretty generic because it's based on the understanding that the central bank is driving the show, and I know where they're going to take price based on principles that we'll talk about after we do the templates. We're going to go into some analysis and use some of these ideas as well that, again, I wasn't going to do last night because I didn't have the time. So let's get into it. The first template is the ICT Classic Buy template, and I just want to double check one more time. We should have audio. Now, the classic ICT Buy template, everyone knows this since I released it on babypips.com in 2010. And it's largely on the heels of a higher time frame support level, that being daily predominantly, and or a 4-hour. If you're framing the ideas that the market's going to go higher on a 4-hour or daily or weekly, the odds of your trade being profitable are exponentially higher than they would be if you were looking at, say, a 60-minute, 30-minute, 15-minute, 5-minute, 1-minute time frame. If you're looking for directional premise, it's not going to be derived off of less than a 4-hour chart. Okay. Now, you can be a trading session scalper or an intraday volatility trader using a 60-minute chart to give you intermediate term price swings to key off of in order blocks. There's nothing wrong with doing that. But the hourly chart, unless you really understand what you're doing, I mean, I can look at an hourly chart and discern what the daily range is going to be, but I'm largely leaning on that the 4-hour and daily over the hourly chart or less. In other words, your daily premise or bias for being a buyer or seller is going to be anchored on what you see on the daily chart and the 4-hour chart. So just have that in your notes. If you're new, you're just warming up to me, this came on, there's a lot of folks that just started following me just in the last 48 hours. If you're new and you're struggling with your trades, trust me, you want to be studying the daily chart and the 4-hour chart and nothing less than that to determine what you should be doing, buying or selling. And we'll talk more about that when we go into actual analysis for the coming week, and then what's already happened in the chart, so we can see some of these things unfolding. So the classic buy day is assuming that you're bullish on the euro. Okay, Euro USD, your daily chart is at a support level. Okay, or it's at a bullish order block, or it's just recently taken out a low, and overall price model suggests that the dollar is going to go down. That's the perfect context or criteria for you to be looking for the classic buy day. I'm going to tell you the actual days of the week this actually unfolds. You ready? Monday, Tuesday, Wednesday. Now, all of my core group know this, but if you're new, go through your charts and you'll see that the low of the week generally is made on Tuesday when the market's bullish. We're going to focus primarily there, because if the market is generally bullish and has undertones that the dollar is going to be weak, all foreign currencies are going to go up based on that assumption. If the market is bullish, Tuesday's London open between 2 o'clock and 4 o'clock in the morning, London will create the low of the week. There's a 70% probability that Tuesday's London Open between 2 o'clock and 4 o'clock in the morning, that this template will unfold. That means it's going to drop down from the opening price of midnight in New York. So every opening you see here, that is referencing specifically the New York midnight candle. That soon as it starts trading, that one specific time period in a 24-hour cycle, that to me is the new day. I'm not interested in anybody else's opinion about Wellington, being the beginning of the new financial day. That may be to you, but I don't see it like that. Okay, I don't see that at all. Um, I look at the markets because the dollar still, I mean, it's the benchmark. Whether you want to agree with it or not, the dollar's it. So until it changes, we have to focus primarily on when the North American continent sees the new day, and it's midnight. Okay. So what happens at midnight? We want to watch that opening price created it right at midnight in New York. Draw that across your charts. If you're primarily bullish, looking for a weaker dollar, okay, that's the context of the marketplace. That sets the tone for you to do what? Look for all of these specific templates. Now, if we are trading at a higher level support level on the euro, okay, and the assumption is that the dollar is going lower, and it's Tuesday, and the market starts dropping down after midnight opening in New York on your charts. Now, wherever you are in the world, you need to determine what New York time is. I don't want to go through the process of telling anyone, either in Twitter or in email, what to set your platforms based on time. Do yourself a favor and just set a clock based in New York time. If you do that, everything I'm teaching you here, apply it to your platform where you're at globally, and trust me, everything will click. It'll be like the last piece of the puzzle. You'll understand time and price then. You're primarily looking for the opening price at midnight in New York, and then the price action immediately after that. You want to see go down, okay? And generally, it'll drop down as anywhere in the neighborhood of 30 to 40 pips. Once it does that, it'll hit another smaller short-term support level. Now, when the market drops down in London, once it hits a smaller short-term buying area or support level, or it runs an area of stops, or it closes a gap, comes down into an area where it's fair value, all those things are taught on my tutorial page at theinnercircletrader.com. The tutorial page is loaded with all kinds of information. If you haven't watched those videos, a lot of the things I'm going to talk about here is going to go right over your head. So if you're new and you're here, you're kind of like in the advanced classes. But I'm not hiding anything. It's all on the website. It's free. You don't have to spend anything. And then there's other additional teachings on this channel you're watching. So go through all that stuff. It's going to take you a while. Don't rush. The low that creates in London Open, once that is established, the daily range will unfold for about 7 to 8 hours from that point. And it generally will go up, blow out the high that's created initially from midnight in New York, and then generally it'll retrace back in between 5 o'clock in the morning to 7 o'clock in the morning New York time. Okay, that's generally like the London lunch. It'll allow the marketplace to retrace, and once it retraces, if you watch a 5-minute chart, what will happen is it'll trade back down into a bullish ICT order block for the New York Open kill zone trade. And if you don't know what that is, you got to go through the precision trading concepts and the sniper trading concepts. It'll teach order blocks and all that business. But I also have a teaching on trading the New York Open also that's several years old on this YouTube channel too. But all the insights are there as well, that you can frame all amplifications and further understandings about what I just said in relationship to New York. It's already out there. So like I said, you have a lot of information to go through to get this stuff, but it's free, so take your time and go through it. But generally, the New York session will create a continuation of what's established in London. It'll expand and trade up into its average daily range, or more specifically, you're holding it for time. You're waiting for it to trade into the London close time period, or the ICT kill zone for London close, which is 10 o'clock in the morning New York to noon New York time. So what we've just described here is the entire daily range. completely conceptualized. I gave you the context of when it occurs. I told you what day of the week it occurs. I told you what has to happen to make it uh, come to fruition. And we're actually going to look at examples of it after the fact. Once we go through all the templates, I'm going to actually give you some examples of each one of these in the cable. British Pound USD, for those who know what that is. The classic buy day is one of the easiest ways to make money trading Forex. It's like the days that are just so easy. They're just so easy. If you have been working with my material for a number of years, I started exclusively teaching in 2010 foreign exchange. Um, I moved primarily to Forex only in 2006, and I can tell you I'm still absolutely astonished on how consistent the things I'm sharing with you today are. And today you're going to see some further examples of each one of these templates, and it's going to be very exciting for you because I know most of you, even those traders that have been following me for a while, um, they still see things after the fact, but they still don't get it quite right as it's happening, so they can put the trades on. They're still hit and miss about a lot of things because price action is it's unclear to them, and it's because they have not learned how to profile the market. And you have to understand market profiling because at the central bank level, there are not individuals sitting around in front of a computer screen saying, "Okay, I'm gonna hit this button and it's gonna spread the market open like this and that." That's not what's happening. All of the feed that we have through pricing is all electronically driven by algorithms. And the way the algorithms are set up, they are designed and programmed to do certain things that are inherently generic. When the market's going to go up, it's not a surprise to see it go down initially first. It goes down to neutralize those individuals that may be in the marketplace. They squeeze them out of positions because they know most traders or most speculators will have a trailing stop loss below recent market lows. And once it goes down, it takes those individuals out, or it induces traders to sell because it looks like it's moved lower. And that initial move down, like we're seeing in this graphic depiction here, is what you're capitalizing in. You're not focusing on buying strength. You're buying what would be conceived as weakness, okay, on price study. But what you're actually doing is you're buying VIP pricing. You're getting right in there when the banks are actually trading. Okay, when the smart money investors, when the banks themselves are formulating the daily range, do you think they want to be buying when half the daily range has already been fulfilled on the upside? Absolutely not. They're scaling out of their positions as it goes up. Where do they get in at? When the market starts going down initially. So smart money buys when it goes down and it sells when it goes up. It's a difficult thing for new traders to grasp, but once you study it for a length of time, you get really desensitized to it, and then you'll understand that you certainly want to be buying when the market drops. When it's going down, it feels like it's the wrong thing to do. And it took a lot of time for folks to trust this template, but now they see it. It's like it's clear. You can't miss it now, and we're going to look at it in examples. But more importantly, this this classic buy day template is the easiest one to trade. It has the easiest context to trade within. It's day sensitive. Monday, Tuesday, and Wednesday. It is highly um, symmetrical. In other words, what you see going on in London sets the tone for the entire daily range, and you can do certain measurements and projections on it, and it'll give you very close to what the daily range should be once it trades above the opening price at midnight. Once that happens, then you can start doing all your projections and get where the upside should be or where the high of the day should form. And many of you that's been following me for 6 years now, you've seen many astonishing examples of to the pip, the high and the lows been called before the fact. So what we're looking at again, just for clarity's sake, because I kind of went down a little bit of a rabbit trail there. The classic buy day template is best found and traded on daily and or 4-hour support models. In other words, if it's at support levels, if it's down into an ICT bullish order block, if it's this recently swept a low, and the overall context of the market is still going higher and dollars going lower. and it's Monday, Tuesday, or Wednesday. Okay, this phenomenon is what you would anticipate seeing unfold. You get in there, you look for the reasons to buy at London. Um, Once it takes out the opening price that's formed on the midnight candle at New York, in other words, midnight in New York, that opening price, once it trades above that price level, what you're going to sit and do is you're going to wait, and you're going to wait, and you're going to wait, and you're going to be in profit if you bought London. If you bought London, you're already going to be in profit, and probably going to be 40, 50 pips profit. Do not, do not collapse your trade because you got that real explosive move. Don't do that, especially if it's just now getting to around 5 o'clock in the morning in New York time, because what it's going to happen is it's going to go consolidating sideways, or it may retrace back. Don't trail your stop loss up inside the daily range. Don't do that. Keep your stop below the low that was formed in London. If you feel uneasy, take some of the position off. That way, if it comes back and hits your stop and you were wrong, you made a little bit of money. Do not buy into this stuff that other teachers say. You put a full risk on, a full stop on, and it doesn't make sense to take partial profits because you had initial risk of X and you're only taking a split of the potential gain. Forget all that. Okay, trust me. If you learn this, the averages will take care of themselves. You need to be paid. Period. You need to be paid. The folks that hold for everything, they'll show you full stops. I rarely get a full stop. In other words, I rarely get a full stop out. I'm getting paid, I fund my trade, and then I allow the market to explode in my direction. So that second half of that trade, believe me, I'm killing what most of those other traders are doing for their full profit, with their full risk on. If they're risking 2 to 1, which they're only risking $1 to make two. My trades aren't framed like that. I'm looking at 5, 8, 10 to 1. And if you understand the daily range, believe me, it's easy to do that. And if you understand these templates, I don't need to have a full 100% what I bought on exit out my profit level. I don't need that to make money. I can make a ton of money having only half the position pay me. I'll fund my trade, taking some level of predetermined profit, usually 20, 30 pips. That's what I use as a go-to. Once I get 30 pips profit, I'll take something out. Maybe 25% of the trade, and 75% will run. But the remaining balance, even if I took 75% off and left 25% on, many times you'll see that the remaining balance that you take after you take a partial, the second half, which is less, pays more than what you made on the first. So again, we don't trade to be right. We're not trading to be better than the next guy. I'm not trying to put my statistics against anyone else. I'm doing it because I want to make money. That's all you're here for. You're here to learn how to make money. I'm showing you how to do that. But you're going to have to do some things that's going to fly in the face of what everyone else calls what you should be doing. And if everybody's doing that type of stuff, and the odds are 90% of people lose their money, why would you be listening to what everybody else should be doing? I don't want to do what everybody else is doing. Again, you go to work what? To get paid. You don't go to your job to punch a time clock and sit around and say, well, I showed up here all day and the boss said, well, look, you were here for 8 hours, but you went home for 15 minutes early. So because you didn't do that, I got to take all of the day's pay away from you. That's what can happen if you don't take out something in your trade. Think about it. How many times have you been in a trade and you don't allow that market to move for you? You had a nice little range of maybe 25, 30 pips. You could have taken something out, but greed held on, and you collapsed the trade, and you didn't get to be able to do anything. It comes back and take your stop out. That's the phenomenon that will take place every single time. Every single time if you do not take partials and you allow your stop to be hit. Now, I know some of you are saying, well, I could avoid a full stop by trailing my stop loss up. Yeah, okay, I get that. If you see the range move in your favor and it trades above the opening price on this template, okay, in other words, the euro is traded, made a low in London Open, and moved above the opening price. It's made at midnight candle in New York. Once it trades above that opening price, if it's 20 to 30 pips, take something out. I don't know what you are going to take out. It could be 25%. It could be 10%. It could be 50%. It could be 75% and leave 25% on. Whatever that position is, take something off. Now, for those that are hardliners and say, no, absolutely not, I have to keep the full position on because I took the full risk on. Well, once it's moved up in profit, that initial risk is no longer a factor. So why are you holding on to the past? The trade has to be managed. Okay. When I was teaching prop firms and I was teaching, I was consulting, okay, in brokerage firms for their trading desks. All these things, okay, all these things came up as problematic sore spots. And believe me, these are the same questions everyone has when they're in a trade. Where do I move my stop? Where do I take my profit? Most emphasis is placed on where do I get in, and that's the least important thing. It's the least important thing. When to get in is the least, because you can be a little bit off with your entry, but you have to be right at your exit. Think about that. You have to be absolutely correct where you're getting out of the trade. That defines whether you're making money or losing money, because you can be sloppy in your entry and ultimately be profitable. Think about it. So don't feel rushed to learn. I got to know where to get in and when to get in. Don't worry about that, because without understanding where the market's going to move to, you won't have the opportunity laid in front of you. You'll be fooled by chaos and randomness, or your will being imposed on the marketplace. You can't do that. So if you have a template like this unfolding, and the criteria is the dollar's bearish, it's Monday, Tuesday, or Wednesday. The opening price at midnight, it drops down from there. Don't be scared when it starts dropping down. Don't think, oh, this isn't going to work. I don't want to buy like this because it's going to keep going down. Because the move, when it drops, sometimes it's very quick and sudden. And that's a tip-off. The faster it drops down initially after midnight, when you start seeing real thin runs down lower in price, that's what you want to see. You want to see that. Because what it's showing you is that price is skipping and jumping all the way down to a lower price to knock out or collect orders that are below the market price that's established at the open in midnight. In other words, whatever that price level is at open in midnight, there's orders below that price to buy. There's also orders below that price to sell. The context is it's dropping down initially to squeeze out the bulls that have been already established long and their stop loss is just below recent market activity. And it's also tripping individuals that have sell stops below it to get short on a breakout. So what it does is it engineers liquidity on the other side of what the smart money wants. So if they can drop price down, okay, and that's what the algo does, it automatically just drops down and offers pricing below the marketplace. When it drops down to an area of liquidity, what will happen is once it fills a certain number, okay, which is called the float, F-L-O-A-T, not flout, it's float, F-L-O-A-T. Once it does that, okay, what they're doing is they're building their book for the daily range. So they're setting the initial low of the day, and if it's in London, it's going to be 80% of the time, it's going to be the low of the day, between 2 o'clock and 4 o'clock in the morning, New York time. Don't take my word for it. Go into the charts. You'll see it. Once it drops down there, you're going to buy it when it's going down. You want to be entering in on a down candle. Once it's dropping, when it hits a level of support or it runs a short-term low, when it does that, your mind needs to be clicking, firing off, I'm buying, I'm buying, I'm buying. It's not going to feel right. It's going to be scary. It's going to feel like this is the stupidest thing you should be doing. Do it. Then wait. When this thing drops at least 15 to 30 pips on average, once it does that, if you demo trade this idea with a demo account, and use a 50 pip stop loss from your entry point. So in other words, it's got to drop down 15 to 30 pips from the opening price at midnight. Once it does that, you look for a support level or you look for a low that it cleans out for stops. In other words, it's going to go below a short-term low. or it trades down into a range, which we'll talk about after we actually go through the templates. Once it does that, you're going to be basically buying the low of the day, and you're going to allow 50 pips on a stop. Now, some of you are probably used to ultra short-term 5 and 10 pip stops, and probably seeing a lot of stop outs. And that's the reason why, because static price action alone is going to knock you out. When you're learning, you got to have some room, okay? And I don't think anything less than 40 pips is where you should be at if you're starting to learn, because it'll give you a little bit of a fudge factor, because you're not going to do this right when you're first learning. And in a demo account setting, you have to learn the engineering on the daily range. Do not buy into you have to have a live account. Don't do that, because you're not going to learn anything except for how to be a sore loser about losing money. Trust me, that's not how you learn. Okay, you cannot learn these principles when any amount of money is attached to it, because the tug of war of being right and wrong will be expounded and amplified with any measurable amount of money attached to it. It'll feel like waste to you, and you don't want to do that. Time enough is a valuable investment. You want to just focus on that. So when London drops down 15 to 30 pips, and the criteria is Monday, Tuesday, or Wednesday, and the dollar is bearish, and we're assuming this is an example of the Euro USD, okay, you're going to be buying between 2 o'clock and 4 o'clock in the morning, New York time. Okay, once you buy, doesn't matter, even if you're new, you don't know what an order block is, don't worry. Just once it drops down 15 to 30 pips, buy it right there, and then put a 50 pip stop loss on that trade, and then sit back and wait. You are not allowed to take any profits until it's at least 7 o'clock in the morning, New York time. But you're going to try your best to be patient and watch what happens on the daily range, and allow the daily range to grow and expand on the upside. And it's going to reach into the time window between 10 o'clock in the morning and noon, New York time. Why is that? Because the central bank has an algorithm that works off of time. And once it creates the low in London, it will draw price higher and higher and higher and higher until it gets into 10 o'clock to noon in New York time. That's London close. A great deal of volume drops off. Now, it doesn't mean the daily candle can't keep going higher, because it can. It can make a higher high all the way up to 3 o'clock in the afternoon in New York time. Generally, you want to be out by 2 o'clock in the afternoon, New York time. But that last hour between 2 o'clock and 3 o'clock, when the bond market closes in the U.S., that's generally when it caps the high of the day in all the currency markets, because interest rates are the largest driver in foreign currency trading. That's it. That's the driver. So if you understand interest rates, you'll understand where the markets are going to go on a higher time frame. So that's my fundamental perspective, which we're not going to talk about here, but that's one of the things that you have to have a greater understanding in. Then you'll be able to pick out these longer term macro trends, and then you can really get in there and use these types of concepts and make a boatload. But learning this template was the first one I gave everyone. Learning it is important because, number one, it teaches you all facets of how I trade. It gives you a clear context of what you're going to be doing, which is what everybody wishes they knew when they first started. And some of you have been trading for a while, you still don't know what that is. You don't know what you're doing. You're still looking in forums for something that's going to work better than what you're doing. You can stop looking now. This is what you're looking for. Trust me when I tell you that. I made a career in Forex, okay, teaching with the idea that I know exactly what you're looking for. I know exactly what you're looking for. I know how you want to trade. I know what you want to trade. I know how you want to get in. I know how you want to get out. And I know you want to make money, because this is what everyone wants to do. You're not in here to have fun. You might have fun as a default, but you're here to learn how to make money. You have to trim away some things, okay? And the largest thing is impatience. Some of you that are new are probably saying, shut the hell up and get on with it. And guess what? You're going to have a problem with me. You're going to have a problem with my method. You're going to have all those things are going to be problematic for you. Learning these ideas won't happen overnight. It's going to take time. I didn't learn it in one night. I got 23 years in this industry, and I'm telling you, once you submit to the time aspect, all your trading will be a lot easier. And looking at this template here creates that model to trade with. It teaches patience. You buy at a specific time of the day based on specific criteria. Dollar is going to be bearish. Euro USD should be bullish. Is it Monday, Tuesday, or Wednesday? You're going to be a buyer. When are you going to buy? In London. How do I know when to get in? It's got to drop down 15 to 30 pips from the opening price at midnight in New York. Whatever that opening price is at midnight, at New York time, on your charts, you draw a line across the entire day. And you want to see it drop down 15 to 30 pips from that level. You don't care that it goes above it, because it can go above that price initially. But you want to see it drop down from that opening price until around 2 o'clock in the morning New York time. Once you see 2 o'clock in the morning and it's below the opening price on the euro and it's dropped 15 to 30 pips, buy it. Put a 50 pip stop loss on and then wait. I'm telling you, what I just taught you right there is exactly what you're looking for as far as getting in. Now, there's lots of ways to fine tune that and reduce it where you get down to a 20 pip and 30 pip stop loss consistently. But I don't generally like to trade with a less than a 30 pip stop on London, because there's a lot of noise that can come out in that time of day. So I generally use about 30-35 pip stop loss. But 50 pips will give you a little bit of a fudge factor. Now, why? Why 50 pips? Why do I use a 30 pip stop loss? Because if you understand that the daily range on an up day, look at a daily chart. I don't care what currency pair or stock or whatever it is. If the market went up big for the day. Now, I already gave you the context of how to know when the market's going to go up big. I already told you. I've been repeating it on this one template alone. The dollar needs to be bearish. The euro needs to be at a support level. It's got to be Monday, Tuesday, or Wednesday. When are you going to buy? Well, there you go. You know exactly when you're going to be a buyer for the rest of your trading career. You know what days you're going to buy. You know what time you're going to buy, between 2 o'clock and 4 o'clock in the morning, New York time. Guess what? It is that easy. I've been doing it for years, and it never, ever changes. Why? Because the algos at the bank level never change. It's the same monotonous routine over and over and over again. And there's nothing retail about this. There's no trend lines, there's no moving averages, there's no Fibonacci, there's no Ichimoku, there's no Heikin-Ashi, there's none of that horse shit. It's all accumulation, distribution, and manipulation. They're the three things you have to understand. The market will open at midnight in New York time. When the context of the marketplace is bearish dollar and euro is supported with some measurable level of support, the context is what? Dollar's down, foreign currency is going to go up. What's going to happen is the dollar, okay, will have a move that suggests that it's going down. But there may be an initial spike lower in the Euro USD, which is going to fly in the face of your understanding. It's going to be like, what the hell is this? This should not be happening. If I should be seeing the dollar going down and it's drifting lower, all of a sudden the euro's dropping? That don't make any sense. They shouldn't be going in the same direction. Exactly. That's a crack in the correlation. Correlation between a stronger dollar, weaker foreign currency, or weaker dollar, let me make sure I say that right. Weaker dollar, stronger currency, stronger dollar, weaker foreign currency. So it's like a teeter-totter effect. It's very simple. But the problem is you get caught up on short-term price action and you get scared. Even if you're in a trade, how many times have you let go of a winner and it exploded in your direction because you saw something stupid on a 5-minute chart that scared you? It didn't even get close to your stop. You just thought it was going to run to your stop. This template will teach you how to just stick to your guns. Dig your heels in and submit to time. It also teaches you trade selection. Cherry picking the best scenarios. You want to make a lot of money? Shit tons of money. You want to make lots and lots and lots of money. This is the template you do it with. This is the one you're looking for. This is it. And I taught it in 2010, and still people are looking for something else. This is the holy grail. This is the one you're looking for. And it happens every single week. Every week. And I taught it only takes 30 pips a week to double your money every single year. only risking 2%. You don't need 1,000 pips a month. And if the daily range is an average of 100 pips, generally, that's the reason why we have to see it drop down 15 to 30 pips from the opening price at New York midnight candle. Once midnight happens at New York, look at the opening price on that hourly candle. That's the one you're going to use right there. And then what you're going to do is you're going to see price hopefully drop down 15 to 30 pips from that price point. When will it happen? Are you going to trade at 12:15 New York time? No. You're going to wait. Well, it's already dropping down, Michael. It's dropped down 20 points. 20 pips it's dropped down, and it's only quarter of one in New York time. You wait. It's going to drive you nuts. You're going to want to get in there. You're going to want to get in there right now because you think you're going to miss the move. Wait. When it gets 2 o'clock in the morning New York time, then if that same criteria exists, you buy it. At what price level? Doesn't matter. It's got to be between 15 to 30 pips below the opening price at midnight. Who cares what that price is? It has to be 15 to 30 pips below the opening price. Now, what if it's 60 pips down below the opening price? You wait till New York. Why? Because you have to see if they went into a larger projectionary state and they dropped it farther than the average daily range generally will build. And then what will happen is if it's going to be bullish, it'll come back aggressively between 5 in the morning to 7 o'clock in the morning, New York time, and then it'll create a continuation in New York, which is what we're seeing here. Okay, but generally what you'll see is 15 to 30 pips down from midnight to 2 a.m. in New York time. Buy it, 50 pips stop. What if it stops you out? You got stopped out. That's inexperience. You have to log that. And here's the thing. It's going to eat at you. It's going to make you feel like it doesn't work. There's no validity to this. And you need to put that aside. Look at the next day. If the same conditions exist, bearish dollar, bullish euro, could go and do the same thing. Believe me, once you capture one daily range like this, and if you're catching, say it's a 100 pip daily range, the reason why we're using a 50 pip stop loss and we're requiring the market drop 15 to 30 pips below the opening price at midnight, if the average daily range is 100 pips and it's going to be an up close, look at all of the asset classes out there. Stocks, bonds, foreign currencies, forex, futures, all that stuff. Look at the daily ranges, okay, and look at an open, high, low, and close bar, not a candlestick. Look at it as an open, high, low, close bar. And you'll see the opening price on an up day is generally in the lower 20% of that daily range. It's going to be real close to the low of the day. And the high, you'll see the close near it. That's a big, large up range day. That's accumulation, okay, that's evidenced in the marketplace. But that's not, and it's not, you can't make money on that. You have to see these things before they occur. You have to be able to anticipate them. And you got to do it when everybody else is scared shitless to do what you're about to do. You're buying the low of the day. The banks are not scared of doing what they do every single day because they know largely human beings suck at following rules. I broke the law just, an hour ago, taking my kids to school. I was speeding. Shouldn't do it, but I did. Signs all over the place. 30 miles an hour. Not me. I'm going way too fast. Now, I'm not speeding through a school zone, but down my main artery, getting out of the neighborhood I'm in, I generally speed more than I should. You do too. Don't lie. Don't judge me. We all have problems following rules, okay? Human nature is very easily manipulated. You have to do the very opposite of what you feel is the right thing to do as a retail trader. And that means when the market's tanking, but the overall context is bullish, you need to be buying when it's down there, and you're going to be buying the low of the day. You want to be buying below that opening price and holding. Come hell or high water, you are holding until 7 o'clock in the morning, New York time. And then what will happen is between 7 o'clock in the morning and 8:15 or thereabouts, New York time, it's going to give you one more smaller little retracement generally. And that's probably going to scare you shitless, thinking it's going to come back and knock you out. Don't, don't collapse the trade. If you feel like you have to do something, take your stop to break even. That's the minimum, okay? But certainly take something off in 7 o'clock in the morning. Take something off, especially if you have 20, 30 pips in profit. Take a piece of it off and go to break even on your stop. And then just sit back and wait. Here's the best thing. Turn your computer off. Don't look at your smartphone. Don't track the market. It's going to be hard for you to do this. It's going to be really hard. Really freaking hard. And that's training. When you're working out, you're going to sweat. Sweat's progress. Eventually, the weight that you're lifting in your workouts won't be that hard. Just like this won't be that hard. It'll be easy over time once you desensitize yourself to the whole process and you trust what I'm telling you here, because you're not going to believe me. And I know a lot of you are shaking your head and this is bullshit. But the folks that have been with me since 2010, they all know it's the gospel now. It happens all the time. You have to submit to time. You have to do that. You got to relinquish what you're believing is control when it's none, because you can't control what the market's going to do. You have to submit to it. If you have a conviction that the market's going to have a higher close today, where's the close at? Where's the close? Okay, if we define the close at, say, noon every day, regardless, obviously it can trade past noon. Okay, but if we establish noon is the close in New York time, so we believe the market's going to be bullish, and the assumption is this is an example of the euro. Okay, we're looking for a drop down after midnight in New York time into 2 o'clock to 4 o'clock in the morning New York time. We're going to buy it, put a 50 pip stop loss after it's dropped 15 to 30 pips below the opening price at midnight. It's got to be Monday, Tuesday, or Wednesday. You buy it, you hold it until at least 10 o'clock in the morning New York time. Why? Because we believe that the close is going to be higher than that opening price that was seen at midnight in New York. That's the context. That's the template. That's what your thought process is. The algo is going to stretch the daily range to 10 o'clock to noon. If it's going to be a bullish day and you get out before 10 o'clock, you've cheated yourself. Many times you'll see between 9 o'clock and 10:30, that's the biggest extrapolation in the daily range. In other words, it's going to be explosive between those time periods. How many of you just wrote that down in your notepad? If I was in the same room, I'd be probably pissed off that you didn't do it. But I just gave you a nugget that just goes unnoticed. On up days, look at 9 o'clock in the morning New York time to 10:30 in the morning. That's where that last surge of price action comes in and explodes. And guess what that's doing? It's making the high of the day. Don't believe me? Go into the charts and you'll see it. We're going to look at examples of it. Time and price is what your goal is in terms of learning. Submitting to both. You can't control price and you can't control time. You can only control your reactions and your expectations between those two things. But ultimately, you have to submit to both of them. But both of them are useful tools in a smart money trader, because the banks understand those principles. They use them as tools. They manipulate price. Why? What's it? Manipulating price dropping down like this on a classic buy day does what? It manipulates the minds of traders. It either induces them to want to sell short, or it scares them out of the marketplace, and if it's approaching their stop, they'll collapse the trade. What are they doing? They're selling. Why would they want it? Why would the market maker want to create a condition that makes people want to sell? It engineers liquidity. It places willing sellers at a price they want to be buyers at. Two o'clock to 4 o'clock in the morning, New York time, Monday, Tuesday, and Wednesday. If you got a bearish dollar, if it's got room to go down on the daily chart on the US dollar, if it's got room on a 4-hour chart to go down, if it hasn't reached a certain level of support, the context is you got a green light go, start looking for the bulls to unfold in the foreign currency market. It falls off in terms of odds precipitously on Thursdays and Fridays, unless the week has been consolidating Monday, Tuesday, and Wednesday, and the context still exists. Then you'll see a Thursday, Friday big pop because they've kept market tight. Usually on interest rate announcement stuff, that's usually what you see. But individual day templates, that's what we're studying here. The individual daily price model that sees from the opening at midnight in New York to say noon in New York time. So we're looking at a 12-hour window, easily defined. No, that's not true day format that guys are used to, but I'm trying to give you a very easy way to study this and be able to see the phenomenon take place and repeats itself all the time. Every single week, one of the majors does this on a Monday, Tuesday, or Wednesday. And I know you don't believe me, but you will once you get off this webinar and you just go through your charts. And you'll suddenly see that, wow, ICT has been preaching for 6 years. Look for one good setup a week. Don't try to trade every day. Don't go for broke. Don't bet too much money and submit the time. Well, that's what this template teaches. That's why I gave it to you first. It's everyone's potential trading career with this one template right here. It's got everything in it. You want to be a London Open trader? This is how you do it. When do you trade? How I explained it. Right in this teaching right now, I just gave you a whole trading career. And you never have to change it. You don't have to ever do anything to it. You don't ever have to tweak it. The only thing you're going to do as your money starts to build, the average risk that you put on will grow exponentially, which means that the profit will grow exponentially. Michael, I can't get up at London. I can't do it. Time won't permit it. I have responsibilities of family. I understand that. I understand that 100%. So what you're going to do is you're going to use the New York session to get in sync with what's already happened in London. And you're going to wait for that second half of the daily range to unfold, trading between 7 o'clock in the morning and 9 o'clock, 9:30 in the morning. There's your next continuation buy signal. And you hold for a move running into 10 o'clock to noon. And it's going to make the high of the day between those two time windows in New York time. And you collapse the trade and get out. And you close it every single day. You don't hold on to it. And you do this every single week. And you do it for 1 month. And you look at the results of what you have. Here's a nice exercise. Look for it every Monday, Tuesday, and Wednesday. Let's pick one side of the marketplace for 4 weeks and trade it on a demo setting. Okay, and I promise you, you're going to show net results for the month that are positive. Some of you can't even be consistently profitable. This is how you formulate it. You start one side of the marketplace, pick one pair, have a set rule base, and stay in it. Don't deviate. Do it for 1 month. You'll know whether or not you're going to be able to trade. If you can't submit to that and just do it for an experiential exercise, because you're going to have to submit yourself to some form of rule-based ideas if you're going to be a trader. If you're going to be changing shit around all the time, you're never going to have continuity. You're never going to have that. It's going to evade you. Every single trader in the annals of history that's always moved things around cannot show a clear, measurable progress that's positive. You're going to be hit and miss. You're going to be plagued with frustration. And it's understandable. You should be friggin' nuts. If you're changing things around, tweaking this and tweaking that, you're never going to arrive at an understanding that's simplistic, that you can measure the progress on. Because there has to be continuity and there has to be consistency. If there is not consistency in your approach, how could you reasonably expect consistency to materialize in your results? Think about that for a minute. I could stop this presentation right now and you've probably learned more than you'd ever need to be a trader. Now, I'm not going to do that because if you know me, I like to go for 3 hours or more. And you probably won't be able to see this whole presentation because you're probably watching it at work sneaking. Shame on you. But this template here is the easiest one to do. And it's the easiest one to see coming. It's the easiest one to anticipate. Absolutely easiest one. Because it's rule-based. It's simple to define. It's easy to execute on, and I gave you the entire trading system around having to use it. Now you can tweak that in terms of risk. You can tweak it in terms of how you want to be as a trader. If you can't be a London trader, you can be a New York trader trading this template. All you have to do is New York at 7 o'clock in the morning. Look where was London trading at? Is it below us? And were we bullish? Okay, well, we're probably in this classic buy template. And we still have some time for the daily range to expand and have a higher close on the day. Don't think because it's moved up 60, 70 pips from London low that it's going to go down from there. A lot of traders say, "Oh, I'm shorting this. This bitch went up 70 pips. I'm going short right now." I see that so many times on Twitter, and I'm like, "What the hell? I'm buying this thing. I know I got time in the day. It's going to rain. It's going to create a higher day. The higher close is going to happen, and it might dip down a little bit, and they're like, "Yeah, it's rolling, and pff, yeah, it's rolling right over top of you, and it explodes up." Our group's usually in those trades. Now, it's hard for folks that don't understand this to see it the first time. And it's hard probably for you to understand this conceptually right now, what I'm talking about. But we're going to actually give multiple examples of this very one here, because I really, really want you to understand this one. Because you really don't need to know any other one outside this one. To be a seller, the only thing you would do is reverse it. The opening price at midnight, you want to see it rally above that price 15 to 30 pips. And it has to be between 2 o'clock and 4 o'clock in the morning New York time. If it's done that, sell it short. Put a 50 pip stop loss on and wait. How long do I wait, Michael? Until 7 o'clock in the morning New York time. If you got 20, 30 pips of profit in there, go to break even on your stop or take something out of the trade. Now, I'm not going to define that for you. You need to know what that is because you're the trader. Do you want to just be 100% conservative and take 75% of the trade off and leave 25% on, let it run till 10 o'clock to noon in New York time for the daily range? There's nothing wrong with that. You can build a career with that and still do very, very well. Or maybe you're splitting the position. You take off half and leave half on with a break-even stop. Never, never, never put your stop loss inside of the range lower than the London high on a sell day. Never do that, and never raise your stop up above the London low on a buy template like this. Do not trail your stop loss into the daily range. Don't do that. Don't do that. Don't do that, because it will and can come back down, sweep the low that's created between London and New York, and still have an up close. Don't believe me? Go on your charts, you'll see it. You have to assume some risk. You cannot make money not assuming risk. You have to assume some risk. But you have to get paid too. So there's a balance. As a trader, we have to balance those problems. They're a problem. I got to keep myself net positive, and I have to get paid without losing a lot of money. I got to keep doing this same balancing act as a trader, and so do you. Otherwise, pack it up, because it's just going to be a short ride. Everything you're looking for is in here. You want to be a London close trader? Counter trend trader? Why anybody wants to do this stuff is beyond me. I've done it. I just don't think it's worth it. If it trades up between 10 o'clock and noon, generally between 10 o'clock and 11 o'clock in the morning, New York time, if you see a failure swing on a 5-minute chart there, get the low to high on a fib, go short, and the close will generally close between 20 and 30% of the upper portion of the daily range that's formed at the initial high between 10 o'clock and 11 o'clock in the morning. Very, very small short-term trade, counter trend trade. You can usually get 10 or 15 pips every single trading day doing something like that. I just think it's not. I don't think it's worth it because it's a lot of one-to-one scenarios. Now let's get back to why 50 pips. stop loss, and why 15 and 30 pips below the opening price as a filter. Assuming again that we're bullish on the euro, this is the case and the example we're looking at the template as looking for the London low to form in euro because the dollar is bearish. If the average daily range, general rule of thumb, is 100 pips. Now it's not. Okay, I know some of you guys are going to go out there, well, the average daily range right now is whatever it is. I understand that. Okay, but I'm using a general rule as it's not unheard of to see 100 pips on average on most of the majors per day. In other words, the daily candle, high and low, generally is close to, if not around, 100 pips. So if we have that as a basis or a foundation, and we require buying below the opening price at midnight, 15 to 30 pips, we've already built in potentially buying in the lower 1/3 of the daily range. If it's going to be an up close day, you're buying the low of the day. This is such a simple thing to see, but it's such a bitter pill. It's like swallowing a cantaloupe because it doesn't make sense to the neophyte. It doesn't make sense to do that. And my mentor doesn't want to do that. He wants to buy above the opening price, and it never made sense to me. Once I understood what I am teaching you here, I never do that anymore unless it's a New York continuation trade. I just don't do that. I cannot bring myself to do that. I want to be a buyer in London below the opening price at midnight because I know if it's already dropped 15 to 30 pips, if it stops me out at a 50 pip stop loss that much, I've basically said it's 80 pips below the opening price at midnight. That's highly, highly unlikely if it's going to be a bullish scenario. The market is not going down 80 pips on average in London Open before it goes up 100 pips and have a higher close. It's not going to do that. Can it happen? Absolutely. But statistically, and we're working within the realm of probability, you can have one of those occur every single month like that, and you're still going to have unrealistic, you're going to have unbelievable and astonishing results. Because what you're doing is, think about this for a minute. Really get this, because I'm going to harp on this template a little bit more before we go to the next one, because this is the one everybody wants to know. They don't realize it, but this is the one they want to know about, because it's easy. Everybody wants easy trading. Plug and play. This is it. I gave you exactly what you're looking for and the framework around trading it. If you can buy, and say you're only risking 0.5% of your total account balance with a 50 pip stop loss. Think about that now. If you're risking 0.5% of your entire nest egg that you have in your account, and you're using a 50 pip stop loss, okay, and you're buying near the low of the day, that's what we're teaching conceptually here. It has to be below the opening price at midnight. 15 to 30 pips minimum, that's your filter. And you can't buy before 2 o'clock in the morning New York time. When you buy there, and you buy near the low of the day, which is what you're going to be doing, and you're going to see me showing examples of this in this presentation before we close it. You're going to see lots of examples of it. You are going to get excited about trading like you've never been before, because suddenly opportunity is right in front of you. Every single weekend you're going to hate it because you can't look for these scenarios. And I'm not trying to incite being a trade junkie, and I've been that in the past. But you won't be able to relax. Your mind's gonna be going constantly, especially if you get really into the charts and you fall in love with searching this pattern out and the context that builds them. Once you learn that, once you understand the principles that I've shared so far just on this one template, once you do this, okay, you'll never ever feel uncertain about what you're going to do as a trader again. It's my goal for you all to know this one like the back of your hand, because if you have problems, you hit a series of drawdown, you have a period of a string of losses, do not forget this one. This one fixes everything. This one right here builds the longevity as a trader that you need. This carves out millionaires. This one right here, this one template right here is the number one principle that I use to make millions of real dollars, not demo dollars. Real, I'm not going to fucking work anymore dollars. That's what this is. You're looking for that? This is what this is. And you're not going to believe it until you study it and you understand, holy shit, every Tuesday and Wednesday, if I've been bullish, I got a 70% chance that the low of the week is going to form on Tuesday. But it could happen on a Monday, and it can happen on a Wednesday. Sometimes it can be Monday, Tuesday, and Wednesday creating this very scenario. Typically, you'll see Monday being consolidating, or it may go up initially, which may scare the shit out of you. You won't want to do this anymore because you'll see the market starting to want to go up on Monday. Great. It doesn't matter to me. I don't care what it's doing on Monday. I'm waiting on Tuesday because if I see this thing drop down on Tuesday after midnight, I'm looking for it to go down 15 to 30 pips into 2 o'clock in the morning, and I'm all over it like white on rice. Because I have not only the highest probability if the dollar's bearish, I'm buying near the low of the day. I already know I'm not worrying about it. Once I put my order in, I'm in the market, I put my stop on, I go to sleep. That's when I sleep. I can only sleep once I get in the trade in London. Now, that's probably going against what you think about. You have a hard time staying awake? You're a new trader? Trade London. Your ass won't go to sleep. You're up. It's like no dose, okay? You are up. Forget 5-hour energy. London open trading, that's the shit. You get in trading that, you're awake. You'll have no problem being awake then. You'll be a morning person then. I used to be like that when I was scared and didn't know what I was doing because I was risking a lot of money and I just didn't feel comfortable because I didn't have an understanding of what I was doing. In 2002, even though I had a long history of trading behind me, Forex scared me because it was so fast, very fast, and there's no limits. See, I came from foreign exchange, not foreign exchange, futures market trader, and when you trade those futures, they had limits where your contract showed you a net gain or a loss up to the closing hour, and when it stopped, you had to wait. What was going to happen between where it stopped trading until tomorrow's opening? And that wasn't fun sometimes. It could be a big difference between where you're in at and where it closed and then where it opens tomorrow or next week. In Forex, you don't have that. It's balls out. You're in there. And if it's running, guess what? If you're wrong, you're going to get your ass handed to you. But the wonderful thing is, when you're right, you have to submit the time to get that lion's portion of the move. Now, I'm talking about specifically the shortest time period as a trader, day trading. Statistically, most day traders lose money because they don't know what you do now. Think about that now. Some of you are probably just sitting there doodling. Come on, get to the next slide. If you're thinking that way, turn the video off. I don't even want you listening to me anymore. Because you don't have the mindset that's going to be required to make the kind of money with these tools. And I mean that. You can get pissed off and cuss me out on Twitter all you want if that's what you're going to do. I don't care. Ultimately, I already done these types of things. I know what it's like to go through the struggles. I know what it's like to lose money. I know what it's like to chase the next best thing. And I don't look for shit anymore. I don't tweak anything. I don't change anything. Nothing. I know exactly what I do, or what I want to do as a trader. And I've known that 100% since 2004. I've known that without any deviation exactly. This is what I'm going to be as a trader. And I don't do anything but that now. And I don't trade any other asset classes. What are you doing? Do you know what you're looking for every single time you get into the market? Chances are you probably don't. You have no excuse now. You have exactly The very thing that every speculative person wants to know. A clear cut business plan that separates them from uncertainty. Is it going to have a loss? Sure. Absolutely, you're going to have a loss. But don't change anything. All you're doing is changing the number and sequence of the trades that you're taking. Next trade, please. That's the only thing that's changed. Your perspective on the next setup. You're not changing the method. You're not changing the perspective on how you view the marketplace. Because the algos at the bank level aren't changing. The only thing they're changing with is price and date. Time is, they're the same filters every single day. They do the same things over and over and over again. And you're probably saying to yourself, there's absolutely no way that the foreign exchange market, $4.5 trillion a day, can be that easily mapped out. And I can tell you, before year 2000, I would have agreed with you. Because I was convinced that those son of a bitches were out to get me only. But I can tell you, once I understood and I just relinquished the ideas of markets being random, okay, they're not random. They're absolutely not random. They work on a schedule based on time, and they work with price. They take a level out, or they drive to a price real quick, or ultimately drift down into or up to a level to draw in or push out the levels of liquidity that exist around those price points. We identify them in advance. Order blocks, liquidity pools, fair value. 3 things. Is there a lot of things to learn, Michael? Yeah, it's a lot of things to understand conceptually. But I only have a couple patterns. I know when I'm going to use them. That's what these ideas are to stimulate in your understanding. And I'm harping on this one right here because this is the one you're going to get the immediate response with. You're going to see it easily. You're going to understand what's going to happen easily. But you're not going to just stop here. You're not going to study with this one for a while. Because you're going to see 5 other templates. One of them that can't make money with, really. But you're going to look at those other templates and you're going to try to figure it out. Because you want to be a master of all things. I wasted time doing that. Once I hunkered down and I understood this template, it allowed me to understand the other ones we're going to talk about. But this one here is the moneymaker. This is the one that if you just trade this one, there's no excuse for you to not make money. So if you're only risking 0.5% of your total equity on a setup like this, and you're buying near the low of the day, because that's what we're teaching here. You're buying the low of the day. That sounds ballsy, doesn't it? That sounds like a load of shit. It sounds too good to be true, Michael. You're full of shit. There's no way this is real. There's no way you're buying the low of the day, Michael. There's no way that we could know before the fact where the low of the day could possibly be. There's no way. Can't be done. Can't time the market. If you believe that, okay, seriously, if you believe that, you're gonna have some real surprises ahead. Because I'm telling you, this thing is working on a schedule better than anything else. It's on a very specific schedule, and it's nice to know that as a trader. It's not random. Absolutely not random. The market will go to levels at a specific time of the day to engineer liquidity. Now, suspend your disbelief just for a minute, okay? Because I know some of you are just here to listen to some stuff and then have some ammunition to come at me and say that I don't know what I'm talking about. And why you spend that time doing that instead of just weigh out what I'm showing. Take that energy, go into what I'm teaching, and you pick it apart. And if you can, come at me with it, okay, and sit down in a respectable tone, and I will eat crow if you can show what I'm showing is full of shit. But I already know. I've made millions of dollars doing this. I've taught people how to do this, and they've made millions of dollars. I have taught fund managers, and they use this stuff, and they've made millions of dollars. Not demo money, okay? Not mini lot traders. Millions of dollars. So if you can have the low of the day pinned down with 0.5% at risk, okay? And say you're buying near the low of the day. Well, let's do some math here. If we have a range expansion and an up close, okay, and it trades, say, 120 pips at the close, you have better than, what, 2 to 1 reward to risk, right? So you potentially have a 1% return. 1% return on your equity. And if you take this trade once a week and you average that, now we're only in the realm of day trading. So I'm going to kind of bridge this into how you can use it for short-term trading too. But then we're going to the next slide. I know you're probably saying, good grief, get to it. But this is what you're looking for. This is why we have live sessions. I wanted to have people that knew what they were doing talk to me like I'm talking to you. I don't like to hear that my own voice. I don't like how I sound. Okay, so I'm not talking to hear myself. I'm telling you, I'm reaching back into my early infancy as a trader and recalling the things that I wish and prayed to God that someone would come out and talk to me with. I would literally be on message boards on America Online begging and pleading folks to step out and say, look, if you know how to trade, please, I'll pay whatever you want to be paid. I will pay you, but just talk to me. Let me know what I should be thinking. Not how should I trade. Because I was convinced stochastics oversold buy signals that was all you needed to know. And that's how I turned $2,600 into $832,000 in 9 months. Being lucky, trading one side of the marketplace. I understand buying. Which, without coincidence, is the reason why I'm starting here. If you haven't figured it out, I've taken you through the whole process I went through as a new trader. Since I started teaching trading foreign exchange on March 2010, I stepped out on the baby pips. And I've taken you, whether you realized it or not, through the entire discovery and the way I learned it. How many of you noticed that? Probably none of you. So you're so fixated on learning what the next thing is. You haven't been paying attention to the big picture. But if you can risk 0.5% on these types of setups and just do one trade a week as a developing trader, you're potentially going to see what? About 4.5 to 5% return a month. Compound that. Did you show that last year in your results as a new trader? Probably not. I'm not saying stay at 1.5% risk setups. I'm not saying that. I'm saying as a beginning trader, even in a demo account, only risk 0.5% because I don't want you worrying about the money right now. That stuff's easy. The money is easy. You staying within the parameters that's set up for a system or methodology, that's the hard part. The submission. Screw you, Michael. I'm not listening to this anymore. I got things I got to do. I ain't got time to hear this. There you go. You didn't submit the time. Change the slide, Michael. You're not submitting. You're not submitting to me. You have to submit to the process. You will learn this over time. You have to spend time in it, looking for it, experiencing it, seeing it in your charts. Mark up your charts every single day. Look how many times this particular profile and template occurs in your trading platform. Look at your intraday charts. Pull up a 15-minute time frame and a 5-minute chart, and map out every intraday on the pair that you trade. Pick one, because otherwise you're going to spend way too much time you need. Pick one trading pair, study it for the entire month of March, and break it down, and see how many times this particular template occurs, and notice the day of the week it occurs. You're going to shit yourself. because it's been there all this time. And you've been chasing harmonic patterns, bats, Gartleys, butterflies, crab patterns. I got better things to do than chase butterflies, get pinched by crabs, and I don't want bats in my belfry. Banks don't give a shit about these cartoon patterns, okay? There's a lot of randomness, okay, in those ideas, and unfortunately there's a lot of overlap with just pure coincidence, because that's really what it is. It's coincidence. If you want to be a gambler, you can bet on that kind of stuff. I want to know where the money's at, and that's where I teach. I teach where the money is. Where's the money going to be made? Where's the market going to get it? And where they're going to take it to unload it for a profit. It's all this is. They accumulate positions. They manipulate the market to get it there so they can accumulate those positions. And once it trades to a counter position level of liquidity, they distribute. That's it. It's very simple. It's a very, very simple process. But you're going to have to get there through time. Now let's go back to our analogy here. Average daily range is about 100 pips a day. We require 15 to 30 pips drop down after the midnight candle in New York opens. That opening price, it has to drop down below that. Once it does, and it's 2 o'clock to 4 o'clock in the morning, because it may require that much time for it to actually go below the opening price. It could start off trading up above the opening price. If it does, do not change gears. Only look below that opening price, 15 to 30 pips. It has to be 2 o'clock to 4 o'clock in the morning. It could have been above the opening price all the way up to what? 3 o'clock, 3:30 in the morning, New York time. And all of a sudden, it breaks lower. 30 pips. Right below that opening price that was formed at midnight in New York time. What do you think's happening there? That's the Judas swing. They're taking it lower to entice people to do what? Sell it. Or, because it rallied initially, folks have what? Their stop loss right below that initial low. Turtle soup, baby. It takes it lower, runs the stops. You know what you're going to be doing. You're buying below the opening. Screw everybody else. Who cares what ICT just said yesterday? Don't worry about what I'm doing or saying. You trade your own setup, and this is the one. I'm telling you, if I'm full of shit, this don't work. But I'm telling you, this one works like Swiss clockmaking. It's beautifully engineered. It's absolutely the grail that you're hunting for. I can say that because I've made millions of dollars with it. I can say it because it's clean, it's cut perfectly to rules. You can't whip it up and distort the information. It's so generic. You know when you're going to look for it. You know what days you're looking for it. You know what time you're going to do it. What the hell else are you looking for? Tell me when there's going to be a bullish divergence in stochastics. I don't know when it forms. I don't know when this bat formation is going to complete. You see the ridiculousness of it all? But we are sold this bullshit through misinformation, because if they keep you chasing red herrings, you won't learn what you're learning today. Think about it. Look at what you're looking at right here. This don't look like anything that you would, attribute to trading. It's too generic. It's too basic. It's too vague. If you think this is vague, you're an idiot. Because this is absolutely scientific. It's so principle oriented. It's perfect. And I left all kinds of room on the left side and the right side for you to have all these notations for your notebook. Because this template should be in there. This template should be on your wall. It should be your screensaver. It should be the wallpaper on your iPhone. I don't agree with tattoos, but if you're a tattoo guy, you know, I'm not going to go that far. Nonetheless, this one here, okay, once you understand it and you gravitate to a greater understanding with it, say you're trading that same model and you've gotten better with fine tuning your entries in London Open. So you can reduce the stop down to a 30 pip stop loss. And now you're at 2% risk. Oh, baby, does it get so much better. If you're buying near the low, trading 2% risk, 30 pip stop loss on average, when this thing screams up and goes 150, sometimes 200 pips sometimes in a day, man, how many of those do you need over the course of a month to take down 15, 20% returns? Monthly. Monthly. I want to double my account in a month, Michael. I'm not impressed by that. Well, turn off the video. I average anywhere between 16 to 20% a month. Now, I know you're probably saying, well, you should be a fucking billionaire, Michael. I reset my balances every January because I don't like to keep money at risk in one place. And I take my money after quarterly disbursements and taxation. I take my money and I spread it out. I don't always keep all my money in speculative funds. I take it and I buy hard assets. I buy commercial real estate. I buy, well, I don't buy residential real estate anymore. It's become a headache. But I have in the past, I have 25 homes that I have a management company take care of for me. So when you are making money, don't keep all your money in the accounts. Okay, you start diversifying and spreading out that money so that way anything can happen in the marketplace. We could see a global meltdown any day. And when that happens, if all of your money's in the trading account, it's probably not going to be coming back to you, and that's unfortunate. But that's some of the risks that we take as speculators. But if you can take this pattern here, this template, and understand it, if you have the ability to trade longer term outside of day trading, man, does your world get bigger. Assume for a moment that the dollar is bearish. Same criteria, we haven't changed anything. Say it's Tuesday, and we have all those similar things we've discussed. At midnight candle, at opening price, in New York time, draw that price level all the way across the entire trading day. You're only worried about being below that level. Once it goes down below that level between 2 o'clock and 4 o'clock in the morning, you're buying. It has to go down 15 to 30 pips to do it. Now what happens if the entire London session stays above the opening price at midnight? You go to the New York session and you look for it to drop down 15 to 30 pips below the opening price that hasn't been breached yet. And once it trades into 7 o'clock in the morning, once that happens in New York time, and it does that phenomenon, 15 to 30 pips below that opening price, then you're going to buy it there too. And you wait. 10 o'clock in the morning, New York time, to noon. You hold on to it. If the setup is poised to move for a long period of time, say, a week or so, and it's Tuesday or Wednesday, and you do this, take something off between 10 o'clock and noon. Take some measurable amount of the position off and leave it go. Let it trade. And you want to hold on to it to a minimum of Thursday's New York, 7 o'clock in the morning. If you do that, you'll have traded the basic framework I use for my one-shot, one-kill setups, where I'm trading the weekly range. Now, at Thursday, 7 o'clock in the morning, I'm usually taking something off there too, and then I may have a very small little portion of the trade left to see if there's any more juice in it going into Friday. But generally what you'll see is London close on Thursday or London open on Friday, caps the week, makes the high of the week, and then it'll trade off into Friday's close. And that would be basically seen with the same template here. The opening would be Sunday here. The low would be formed on Tuesday, and it trades up, makes the high usually on Thursday's London close or Friday's London open, and then finds the close of the week off the high. And that's one shot, one kill using the same template, because these templates are fractal. They can be applied to all time frames. Do you hear that? That's people's minds exploding right now, because now suddenly all this stuff's starting to make sense. All different playing field of opportunities now just became available. And I know a lot of you, it went right over your head. But trust me, it's in video format. You'll know. You'll go back to this video and you'll hear this part again. And you'll be like, there it is. There it was. Yep. And it's always been there. It's always been there. It's easy for you to see this setup coming. It's easy for you to trade it once you understand why you have to wait. Why are you waiting till 10 o'clock to noon? Why do you have to do that? Because that's how the banks drag price along, and they allow the daily range to unfold up to that time window. Okay? And generally what you'll see is the high usually forms between 10 o'clock in the morning and 11 o'clock in the morning New York time. Generally. It's about 70% of the time that's where the actual high forms. So that means you need to be, if you're going to be getting out, I always predominantly like to look for between 10 o'clock in the morning and 11 o'clock in the morning New York time. If I'm in a profitable trade from London Open or even New York Open, if I'm in profit, I am definitely paying myself between 10 o'clock and 11 o'clock in the morning. I know I'm getting something out of that trade. Now, depending upon what I have for the longer term basis, if I think there's more range on the weekly side to expand on the upside, I'll hold about 50 to 30% of the trade on and collapse the rest of it and be paid. What's wrong with that? Forget the fact that I've made a lot of money. What's wrong with that idea? Pick that one apart, because you won't have any way to justify why it's not a good thing. It's actually a very good thing. How else can you capitalize on that weekly range and still get paid? If it goes against you and you let it go all the way back to where you got in at, that's demoralizing. Absolutely demoralizing. You're in this to get paid, and it's not a exchange for time type thing like your job. If you've invested time and you've managed a position it's been paying you, know where you want to be paid at. You know when it's payday at your job, right? Maybe it's Thursday or maybe it's Friday. Okay, but you know that's the day. It ain't changing. They're not moving musical chairs. This is today's pay week, and next week we're going to probably pay on a different day. You ain't going to stay in that job long if it's like that. Just like in your trading, you have made a decision to be exposed to the marketplace. It's offering you pay. Take something out. You have to do that. And here's the thing. When you do that, it's a lot easier to hold on to this, because you got something out. You've taken some skin. You've taken a pound of flesh out. You've eaten a little bit for the day. It satisfies that insatiable it satisfies that that desire that's in all of us. Okay, it's an insatiable desire to be right, and that's what that answers. It suppresses the desire to do something, because you're going to be like a deer in headlights. You're in profit. It's running, and holy shit, do I get out? Where do I trade my stop loss? Think about it. You're a new trader. You're in a profitable position. That's worse than losing money. Think about it. It's worse than losing money when you're a new trader and it's making money quickly and exploding in your favor. You don't know what to do. You're second guessing. Should I get out? Should I trade my stop loss? What should I do? Now contrast that with you're in a drawdown, you're in a losing trade. You know exactly what you're doing. You're holding it. You're not deviating. You're holding it. Think about that. You need to flip that script. Okay? When you're in drawdown, you're losing money, it's deviated outside the boundary that this explained here. Get the hell out. Get out. Collapse the trade. But when you're in the rules that I've just outlined, you do what losing traders do. You wait. See, a losing trader, they're convinced, absolutely, the trade's going to turn around. They're going to be right. You have to apply that mindset to this rule-based idea right here and submit to time, because losers submit to time all the time. They are good submission artists to time because they're convinced come hell or high water, the market's going to turn around and their losing trade's going to be a winner. That's what I've been trying to show you. That paradigm shift, that has to take place between your ears. It's happened with me years ago, but I can't take that and put it into a teaching where it just automatically downloads into your brain and you start doing it too. You have to make a decision that that's how you want to do things. And it's going to be hard initially. It's going to be uncomfortable. But you have to submit to it. Trust it by seeing examples in hindsight. Study it. And we're going to look at examples. But until you see it over a period of time, you're not going to get it. Because you can't build an idea on a very short sample size. I can prove a context and a scenario with a very small sample size. I can do that. But it doesn't change the fact that it has to be accepted internally by you. Otherwise, your brain's going to resist it because you have subscribed to the idea that the way you make money is found in books. It's found on forums. It's found on the internet. It's found in this guru. It's part of this service. It's part of this mentor package. It's not. It's what I just shared with you right now. We covered every facet of trading on this one template right here. Psychology, controlling emotions. How do you do it? Keep your risk small, graduate in your understanding, then and only then maximize your risk up to 2% once you know what you're doing. When you no longer feel excited about getting in the trade, it's like, oh, here's another one. Here's my order. There it is. Now contrast that with now. Shit, man, I don't know. Should I buy it? Let me wait a little bit. Okay, oh shit, it's moving now. Let me get in it now. And then what are you doing? You're thinking, man, I'm chasing it. I know you won't say it out loud, but you're chasing price. And you know your stop loss has got to be way bigger than it needed to be initially. And now you're a Christian. Because you're praying to God, please let this trade pan out. And last time I checked, God's not interested in foreign exchange. You're going to see a great deal of maturity in your understanding if you apply what I've said up to this point. So if you have made a point to watch videos, make a mental note and physical note in your notes right now. Get the time on this video. And you really want to be watching this video up to this point right here a couple different times, especially if you're a new trader. You're going to want to come back to this one after you've gone through all my other tutorials, because what I just gave you right there was the Holy Grail. And I mean that with every fiber of my being. I gave you everything you're ever going to want to know as a trader. I swear that to God Almighty. I know that with every facet of my being. I'm telling you, that's exactly what you've been looking for. And how to use it to grow into a greater understanding. And it is the key to you finding consistent, high probability, explosive trades. Big, huge trades. And how to look for them and see them and anticipate them and trade them and manage them effectively every single trading week. It's not a 50 trade per month setup. That's why it's good. It's not an everyday trading setup. That's why it's the best. It formulates an idea of a systematic approach going in with a clear-cut set of rules that are based on time, day of the week, and what the bank algos do with price. This is the only way you're going to get in sync with the banks. The only way. And you will prove it to yourself. You won't be convinced by me talking about it. I could talk for 3, 4 more hours just on this one template, and it won't convince you any more than until you go into your charts and see it. See it. Study it. Write notes on examples of daily examples of it happening, and keep a record of how many times per week it occurs and what days it occurs, how it unfolds, how many pips it was offering you. When you see that, believe me, you will be excited. You will be so passionate about following this idea that you won't chase anything else. You will be a convert, not to me, not to the guru ICT. Okay, I don't want people worshiping me. I don't want that. I want you to do this stuff and be profitable and take it and bless somebody else with it. That doesn't mean take it and sell or repackage it or put it on your stuff and teach it. I want myself to be the only source of that. But I know some of you are going to take it and run with it and teach it and relabel everything. It's going to happen. But stop. If you feel that need, if you know you're here for that reason, stop just for a minute. Why would you want to do that when if you just traded it, you would do so much better? I'm telling you, I could open up a subscriber base business and you still all collectively wouldn't pay me more than I earn a month. I mean that. So don't do anything except for learn it, apply it, make money with it, and then find other people that are not doing well and just do something for them nice. And then tell me what you did. That's all I'm asking for. I do it all the time. That's the exchange for why I do it. I want a testimony from everyone, what they've done with it. I don't want to see pictures. I bought this car. That's not what I'm asking for. I'm asking for what you did for somebody else, that they didn't expect you doing it for them. Okay? So I have to tuck that in there. I like to do it every time I get really passionate. I'm really, really passionate right now, and you can probably hear it in the tone of my voice. I know a large degree of you right now are feeling relieved because you see something here being taught to you, and the only thing you had to do is pull your ass up in front of the computer and listen. Isn't that nice? Isn't it a beautiful thing to sit down and then listen to someone tell you, hey, number one, you can do this. There's a way out of what you've been doing to yourself that's been hurting you. There's a way to define how you're going to trade. Every single time you're going to take a trade, this is how you're going to do it. You're not going to Mickey Mouse around. You're not going to twist it up. You're not going to deviate. You're not going to tweak it. You're not going to ask for somebody else's opinion. You're not going to look for encouragement from someone else that does the same kind of ICT stuff. You are your own island. There's a saying that no man's his own island. You are, in trading, you are. You have to be. You absolutely have to be. You're the CEO of your corporation. And this corporation that you're trading either sinks or swims based on your understanding. And if the CEO of any company is out of his gourd or her gourd and doesn't know what he's going to be doing or have a clear-cut rule and business plan, that company's going down. So I've given you all these building blocks here, okay, to be a day trader and a short-term trader. There's no reason why you can't be profitable now. And we've only talked about one particular setup. When's it occur? How does it occur? How to trade it? How to profit from it? How to manage it? I gave it all to you right here. And I could stop right now. We're not going to, but I could stop right now. And I'm telling you, what I've just given you so far right now is better than anything else out there. Why do I know that? Because I've spent over $250,000 buying other people's shit, and it's all horseshit. You don't know when something's going to take place. You'll know it when you see it. When this thing lines up with that, when this indicator crosses over here, when this thing turns green, you're looking at everything else but price. And that's why that stuff doesn't work. The only thing we're looking at is price. Because I want to know what the banks are doing. And if they tip their hand, I'm going to be all over it. And so will you. So will you. The banks are not changing their business plan week to week. It's their playground. It's their business. Currency is their product. Money, stacks of money. Okay? The idea, the value of money is what, if they had a store, that's what would be on the shelf. You have to understand price. You have to understand that. You have to understand, why does it move? It's an animal. It is a real thing, okay, that has a very generic characteristic to it. It repeats every single week. Look at how many times you've lost money over however long you've been trading. And I guarantee you, if you go back into those times where you lost money and you look at what we're sharing here, you probably wouldn't have taken that big of a loss or that many losses. And you probably would have had a lot more winning opportunities. Last bit on this one, then we're going to the next slide. If you miss a setup, don't chase it. Let it close, study it, mark it up as if you did take the trade. Mark on your chart where the ideal entry was, where the stop loss would have been, how much risk you actually sat through in drawdown before it actually went to a profit, and then how much the trade would have been profitable. Okay, and use the opening price at 10 o'clock in New York as your closing price. If you missed the trade, use that as your basis, because you don't know where you would have gotten out at while you would have been in the trade. It's all different because it's hindsight looking at it. But use the worst case scenarios for hindsight backtesting. And even in that condition, you're going to see this is absolutely astonishing. So next slide. All right, the next one we're going to look at, let me double check, make sure we got audio because we had issues last night. Okay, we're still treading along. I'm going to ask for one more audio check just to confirm before we go into any more. Thank you so much for that. All right, so the next one we're going to talk about is the London swing to Z-Day. Now, again, because we're predominantly looking at buying templates for intraday price action, what we're giving you is an idea on how I internalize what is going to most likely unfold for the daily range. Obviously, because we spent the lines portion of the presentation on the first template, that's where everyone should be looking for. That's the one everyone should be studying and hunting. You want to stalk setups, that's the one you look for, okay? That big classic buy day or sell day if you're going to be a bear. Just reverse everything in all these templates for the sell side. ICT London swing is traditionally going to be very close to what you see going on in that first template. It's going to look like a classic buy. What will happen is it'll drop down from the opening price at midnight and give you a really good entry price to get in and get long. Unfortunately, it only goes up a little bit above the opening price and then fizzles out and trades back down and then eventually goes into a range-bound consolidation. Now, when this unfolds, it generally is, it's going to be in the middle of a larger swing. So if the market is on a daily or 4-hour chart, allowing potentially higher price moves, but it's already moved a great deal already quickly, the market's going to want to consolidate. Now, strong moves don't really retrace that much, and that's why this template will actually be occurring. So what happens is if you say, for instance, you have a really strong Monday and Tuesday buying scenario, okay, maybe those 2 days have been a classic buy day, and we had two really explosive up days, and maybe it's moved like 300 plus pips. The market's going to want to take a breather, and it still will give you a buy in London, but you have to be anticipating this template on the heels of a big series of 1 or 2 or maybe even 3 trading days. Maybe Monday and Tuesday and Wednesday have been up days. This will probably occur on Thursday. Okay, generally Wednesday or Thursday, this is the day that this type of template will occur because it needs to pause. If the market has moved on a larger time frame, daily or 4-hour setup, and it's came to the end of the move, in other words, it's moved up for a while and we're hitting resistance levels, this also can form there as well. Okay, and what it'll do is it'll create usually like a swing high on the daily or 4-hour chart, and then the next day it'll start rolling over, going weaker. But you can still profit, and this is one of those templates that why I preach hard and fast. You have to take profits, some measurable amount of profit at 7 o'clock in the morning. If you've traded London Open and you have profits at 7 a.m. in New York time, take something out, especially if you're over 20, 30 pips, because if you don't, this is what could happen. You end up getting caught in the middle of range, okay, and or like we'll see later in other templates, it could be a reversal market profile, and you'll lose everything you've made and probably a larger stop. So again, the criteria is still bullish. The dollar is going to be bearish. Foreign currency is going to be bullish. This template will unfold as a classic London Open buy. So between 2 o'clock and 4 o'clock in the morning, it'll give you a buying opportunity. But once it trades above the midnight opening in New York, okay, it usually will go a small deviation of time and price above the opening price. Now, for those that are familiar with retail stuff, this is generally when you'll see the R1 or the mid-level between R1 and R2 on pivots. Now, I'm not a pivot trader, but pivots, if you like them, this is that template to help you for that, because it will be just like clockwork. Pivots will work perfectly in this scenario or this template, and that's why they work a lot, in textbooks, because they'll use this scenario here. Big explosive days, pivots sometimes don't give you any lineup at all. So the criteria again is middle of a larger swing on the higher time frame, daily or 4-hour. So it's going to want to pause and collect itself. Okay, notice it's not having a lot of retracement, which is typical of a very strong dynamic price move. Big strong dynamic price moves have little to no pullback, but they do have consolidation days. That's what you're seeing here. Okay, so the moral of the story is, by paying yourself in New York, if you've been profitable from a London Open trade, pay yourself in New York will keep you out of being beaten up or driving yourself crazy with this. Once you understand currency correlation also, we could see this scenario like this. Say it's weaker dollar, like the context of all the buy templates would be. Weaker dollar, strong buy opportunity happens in, we're going to say the euro here for another example. London Open trades down 15 to 30 pips below the opening price at midnight in New York. You buy it, it explodes up and trades above the opening price. So maybe you got 30, 40 pips in the trade. Collapse some of the position, pay yourself, put a break-even stop on. If you don't do that, okay, if you don't do that and you start seeing price start to meander going sideways like this, what does that teach you? Don't look for a continuation or a New York setup in the middle of a larger range trade if we're on the heels of 2 or 3 big days up. The market's going to most likely consolidate and go sideways. You've seen me many times in live sessions, and you've seen it on Twitter where I'm saying, okay, look, it's going to go back to equilibrium. And that's what it's going to do. It's going to create a day of equilibrium, which is nice, because eventually, if it's going to be a stronger move, you'll have an initial move the next day or the following day after that. And once it comes back to equilibrium, boom, you got dynamite right there. It's going to explode up, and then the larger price swing will unfold. But you have to learn to pull the plug intraday. If you see this unfolding, in other words, if we make a London low and we trade up, you take some profits, and then we get back below the opening price around midnight, do not chase. Don't chase a New York buy in that criteria if we have 2 or 3 up days that just passed, because it's highly unlikely that we're going to see an expansion on the upside beyond what we already priced in. Okay, it's going to go into consolidation. It's going to create a very narrow day, which is nice, because small ranges on a daily chart create what? The opportunity for big ranges to come. So you get paid essentially, nonetheless. You're getting something out of the marketplace, and then once you see it, just collapse the rest of your trade and just go back in the next day looking for the same scenario. if it doesn't create a scenario that lines up with the London buy the following day after this formation, chances are we're probably going to see a retracement, and you can be an intraday short seller and use the flip side of all these templates looking for shorts. So we're going to move on to the next template. So again, that was the London swing where it gives you a buying opportunity and it moves into 7 o'clock in the morning New York time. You want to take your profits there because this is what can actually occur, and then it starts going sideways and it'll just drive you nuts the rest of the day. All right, the next one is the London swing to New York open or London close reversal. Same scenario, like every one of these templates, we're looking for a London open decline of some sort, 15 to 30 pips below the opening price of New York's midnight candle. Once it drops down and gives you a buy, okay, it's going to move up into a larger time frame or higher time frame bearish order block. It'll close a range and move back into a fair value level, or basically an optimal trade entry for those that know what I'm talking about from baby pips days. Or it will be a turtle soup. It'll run an old high, or it'll just be a classic resistance level on a monthly, weekly, or daily time frame. And then what happens is that once it trades up into that level, and it occurs at the time of New York open, and it's on the heels of a larger price move, this could be the transition point where the dollar is no longer going to be bearish, but moves into a bullish area of support. Then this is going to be a market reversal profile. Okay, it'll be a classic scenario of reaching for a higher price to reverse later on intraday. And then once it occurs, and again, it may require all the way up to 10 o'clock to noon, and then the market makes the high of the day there, and then for the next couple of days later on after that, it'll create lower pricing. But the profile or template is used to run up into a higher time frame daily and or 4-hour bearish resistance point. And again, it could be a bearish ICT order block. It could run an old high for a turtle soup, or it could close a range for like an optimal trade entry. So it's very easily understood. If you look at higher time frame price charts, you'll see many examples of that. But it'll eventually come all the way down, clear out the low of London. And if you understand my market maker buy and sell profile, the market maker sell profile is what you'll see in this market reversal profile. It'll have the low created in London open. That'll be the initial consolidation area. It'll move up, create the smart money reversal at the high of the day, which would form at New York open or London close, and then trade all the way down, clearing the low that made in London, which is the original consolidation for a market maker sell profile. And I know it's a whole mouthful for some of you guys that are new, but I promise you, if you ask the folks that have been around, they know exactly what I just said, and it makes perfect sense to them. This is why you got to go to the old stuff first, newbies. All right, the next template we're looking at is the range to New York open and or London close rally. Generally, this is going to be a non-farm payroll event or a FOMC event. The market will be in consolidation. Again, we're sticking with the synopsis. The idea that dollar index is trading bearishly, so we're bullish on foreign currencies. This is going to be classic scenario for non-farm payroll, and I was saying this last night, but I can't remember. I didn't go through the entire recording to see if this was one of the parts you could hear, but I was saying in recent years, non-farm payroll has not shown this pattern as it has in the past. It used to be, it would be in a consolidation, maybe 20, 30 pips, maybe 40 pips for the whole day, and then when non-farm payroll comes out on first Friday of every month, you would see explosive moves after that. Okay, and because it's not like that now, it's been volatile all the way up into non-farm payroll. It's a little bit of a I still look for this phenomenon, but it doesn't happen like it has happened in the past. So because I think of the increased volatility, once we start calming down again, when markets go to a lower level of volatility, you'll see this being a classic scenario going into non-farm payroll. This always will occur at interest rate announcements as it relates to FOMC. Okay, so when countries come out and with their adjusted interest rate announcements, this is what you end up seeing. And the way you understand if it's going to be a New York open or a London close scenario is that if it's going to be a non-farm payroll day, well, the low is going to be run out initially, and that's where you're going to be looking to be a buyer. And this is what I use to trade non-farm payroll. When you've seen the live examples of uh, what was it, January and February? Yeah, or March. Was it February? I think it was February, March. Whatever it is, they're recorded. They're on my website and on the YouTube channel. But I use this template, and I use the one later on when we talk about that one as well for trading those non-farm payroll particular days. Um, the idea is that we're bearish on the dollar, and we may be consolidating in the dollar as well. And then eventually, once we get to non-farm payroll numbers released at 8:30 in the morning in New York time, the market will dive down below the lows. Okay, but the context of the market is still what? Bearish dollar, bullish foreign currencies. So what they'll do is they'll sink it below the consolidation leading up to the numbers release in New York for non-farm payroll numbers, and then they'll explode to the upside. And then there'll be a late day, usually like 1 o'clock to 2 o'clock in afternoon New York time. The range will draw out that long. Okay, when is it going to occur at London close? When there's going to be a FOMC announcement around 2 o'clock in New York time. Then you know that there's going to be a setup that forms around that 11 o'clock to 1 o'clock in the afternoon, that time window for the setup. Same scenario, they'll take it below the low or consolidation of the day, and it suck everyone on the wrong side and then explode up. So we're always sticking to the same premise. We're bullish based on a higher time frame premise. That bias, we're going to milk it until it's completely obvious that it's no longer valid. Okay, and you stick to it, you trade it, you trade it, you trade it until you can't see it working, then you go the other direction. Okay, and it really is that simple. You're submitting to the possibility you're going to lose money, and your trades aren't going to be perfect, but in between those two price points of when transition takes place, when the market moves bullish and bearish, there's going to be a lot of opportunity to make a lot of money. And just trust me, you're going to have losses, but the wins far outweigh those losses, and it won't shake you, it won't make you nervous, it won't scare you. It will in the beginning because you won't trust it yet, but over time you'll see a handful of losses if you trade a lot over a course of a month. Your winners will more than adequately take care of all that and sweep it all under the rug. As it relates to currency correlation, this is another template that will occur. Again, same scenario. We have a bearish dollar. We expect the dollar to be trading lower. It has unfulfilled support levels it hasn't reached to. It has a range to trade down into on the dollar, so therefore there's expected movement to see expansion on the downside for dollar. It opens the gate for upside objectives to move higher on daily ranges on foreign currency. Again, we're using the scenario that we're assuming that we're trading the Euro USD. And say, for instance, that we have seen recently the down move in the dollar, and maybe the cable had been rallying, but the euro had been in consolidation. Once the dollar, shows its hand and wants to go lower, you gotta start looking for buys in foreign currency. But if there's a currency that's consolidating and not following suit with higher pricing, look at the crosses that it's related to. Because I'm a fiber and cable trader, which is Euro USD and British Pound USD, if I see one of those pairs being consolidated and they're holding those particular currencies in a tight consolidation, but the other one's closely correlated to it, like the British Pound USD is, if pound is rallying aggressively in concert with the lower dollar, but euro is not, if I've missed a move in cable, I do not care, because I'm going to look at that profile that's staring you right in your face right now. This template is what I'm going to look for in fiber, because once euro pound meets its support level, because that's what's going to happen to cause cable to rally and euro not move. So what's going to be happening in the euro pound? Euro pound's going to be dropping. So once it hits a level of support, cable will move to consolidation and wait. Euro will be permitted to rally. And then you'll see this template unfold. You have to look at the time of day when it's occurring. You have to be looking at your crosses. Euro pound, if you're going to be a fiber or cable trader, you have to understand that particular currency pair. If you do not understand that currency pair, I promise you, you will get smashed. You're going to miss all kinds of wonderful opportunities, but you're going to get crushed and you'll be like, I don't understand this. This doesn't make any sense. It won't, because you don't understand how they're manipulating the entire currency board. It's manipulated with the crosses, okay, through the use of the majors. If they manipulate uh, euro dollar and hold it in consolidation, they're doing it because they're moving the crosses. It's simple as that. It's very simple. If you're seeing euro being in consolidation and dollars rallying, dollars dropping, cables rallying, and euros in consolidation, big setups are happening in euro yen. Euro yen is going to be rallying because euro is going to be consolidation. You're going to be setting up a beautiful opportunity that day or whenever the euro pound hits its support level it's waiting to hit. Once it does that, all focus needs to stop off of cable because it's already shot its wad. It's done. It's going to be waiting up there for for euro to close that gap so they can rebalance because they're correlated pairs. They will move in time given that amount of time. Remember that submission to time thing we've been talking about? You got to submit to that. Cable may be leading the pack now, but like it says in the Bible, the first one now shall be later last. Fiber will get back up there with it if you give it time. Look what's recently happened. I called a long, drawn out consolidation last fall in euro. I told everyone where it was going to go multiple times. It's in recorded format. It's all there before it ever happened. And it's all based on these understandings. I'm not changing things around, and you won't need to either. Once you understand it, you agree with the ideas, you subscribe to them, and you stick to them. Come hell or high water, these are the principles you're going to stick to. And once you do that, you'll always find a way to get in sync with the banks. You won't every day be in sync with the banks, but you will always find a groove eventually over the course of a week. Plenty of opportunities for you to bank some pips. There's many ways to skin a cat. And this profile or template for intraday price action is seen when the decoupling happens, when currency correlation has met its objective. In other words, the scenario is arriving at a bearish dollar. Every currency that's foreign should be rallying. If a particular currency is consolidating, man, check the crosses because that will unlock everything. And then come back to that one because when those crosses meet their support or resistance level respective to what you're looking for, the next shoot or drop will be in that consolidated pair, and then it'll close its range and get back in sync with its correlated partner. For instance, fiber and cable, those two are sisters. One might be stronger than the other on a short term, but they'll always get back in sync with one another. They always do, and that's how you use currency correlation. All right, the next one here. Just want to double check. Okay. I'm very scared that I'm going to lose the audio because I've been talking a lot and I really don't want to do this one all over again. So we have a consolidation raid on news release. Now this one is FOMC specific, and also it can be seen the same way we just disclosed the currency correlation idea. Same thing applies here. Okay, the FOMC I think is the large one. This scenario usually unfolds around interest rate announcements. It can be non-farm payroll, but usually it's not that one. It's the FOMC interest rate stuff that usually happens around 2 o'clock in the afternoon in New York time. If the market's consolidating and all things being equal, say euro and cable are in sync, they're moving in concert with what you see going on in the dollar, so there is no break in correlation. Everything's tight, but they are consolidating. If the premise is still there that the dollar is going to go lower, they'll drop it down initially right ahead of FOMC or as the numbers release. What I do is if I haven't already positioned myself or I'm in a position I'm just managing something ahead of the release, I will wait for that initial drop down after FOMC is released. And once it happens, or maybe it's non-farm payroll, because you can use that same thing there too. If you look at what I did in February's non-farm payroll, that's how I traded that day. I used this premise here, the consolidation and a rate on news. You can see it in the chart. You can see the recording. We're actually, everything I did is based on this phenomenon here. They're held it in consolidation, waiting ahead of the numbers. The initial move is usually the wrong one. Okay, it drops down. I'll buy that, assuming everything's equal with looking for weaker prices on dollar. And this is the one I like to see when there's correlated pair SMT. That means, for instance, if I see a weakness in the dollar and cable and fiber are in consolidation and they're in concert with one another, all the way through London, all the way through New York, okay, or going into New York, and then we have a release of non-farm payroll, or we have a release later on in the afternoon with FOMC. I will wait and anticipate a move down below the consolidation. Okay, it doesn't have to be this graduated below the consolidation. It could be just a little bit below it, but once it trades below it, I'm in there buying it, and it's not going to feel right, especially if it's an interest rate announcement. But once it does that, I'm in there and I'm waiting for immediate feedback. If I don't see a rejection like inside of 5 minutes, that's usually the timeline I'm giving it. If I don't see it give me a favorable feedback within 5 minutes of running below the lows, I'll just cut bait right there because I'm probably going to be wrong. But generally, you'll see that it's not much time. Once it clears out a low and goes back into an order block, correlated pairs with the pair you're watching this and seeing this happen in, for instance, cable may not make a lower low. When Euro does this very thing you're seeing here on this template, I would move to go over to the cable and I would buy cable, especially if there's unfulfilled range above the current market action. If it has filled recent market action above the marketplace and I see that divergence, then I will not use cable as the strong buy because it's already fulfilled the majority of its range. The unfulfilled range on the fiber, which is what we're saying this example here would be or represent, even though it made a lower low, I would contribute that to running the stops below the marketplace. And then because they did that, they paired up orders below the marketplace. They engineered sellers in the marketplace. Why are they going to want to do that? I've taught this since 2010. They're taking money out to take those positions over. Why would they want to come down there aggressively? Because they want those positions. They want to take those positions as buys. They're not going to take the price down there quickly. Okay, with all things being said, in this analogy here, weakness in the dollar, cable was unwilling to go lower, but it's recently moved high. So it's already made a sizable move up. And cable, because it's already priced in a large move, fiber may have unfulfilled range or price objectives above current price action ahead of the announcement. So when this news release comes out, they sync it initially. Gets everybody wigged out. They don't know what they're doing. They think it's going to break lower. So they start selling short. Sell, 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 sell. All that engineered liquidity poses beautiful opportunity for liquidity to be there when large entities go in looking to be a buyer below the lows. And when it does that, you see the classic raid or whipsaw, bang, turtle soup or SMT correlated divergence right there. Bang, it takes off, and then the fiber will explode. So there's a lot of things you have to weigh, even though SMT divergence between correlated pairs, and SMT is smart money tool or smart money technique, which is you're looking for correlated pairs to agree. If they move down, they should be making lower lows in concert. If one fails to do that as a crack in correlation, there's probably some accumulation going on right there, and you have to break down the dollar and the correlated pairs together to see what's most likely going to happen. It's a confirmation tool. It's not a selection tool, so don't go in there looking for it like it's a stochastic divergence. But that this template here, if you see consolidation, these are all the things that you want to do, going through your mind, and the internal dialogue that should take place. That's what I do. It's how I do it. It's how I'm able to call moves ahead of the time and tell subscribers and people that are on my Twitter. If you're not aware of my Twitter, it's ICT Inner Circle Trader, ICT_M Huddleston. I got a lot of new people asking what my handle is, and that's what it is. But this template here again is usable for when there's been a break in correlation, when that pair that has not been moving in concert. Usually you'll see the same phenomenon too. So it's not just limited to just the raid on news, but you'll see that happening right here. That'll be the occurrence that usually takes place around FOMC or non-farm payroll. Next template. Okay, we're looking at the London swing to seek and destroy. Now, this is the one template that you're going to have that will, unfortunately, not make you money. Okay, this is the one that's like the wild card. It's going to be in here to upset you. You're going to see many times it'll give you an opportunity. It gives you the London Open buy. If you're bullish, everything looks like it's going to give you the classic scenario, but it doesn't come to fruition. Okay, it'll go just a little bit above the opening price from London Open if you're getting in there on a buy, because assuming everything's equal here, we're looking for weakness in a dollar. All of a sudden, you're going to see a drop down after midnight in New York, 15 to 30 pips. You'll end up going in there as a buy, and you'll buy it. But it only goes a little bit above the opening price. No meaningful amount above the opening price. There's no way for me to determine this, because this is the one you're going to lose money on. What will happen is you'll expect it to expand into 7 o'clock in the morning. It won't. It'll come back down, clear the low, and that's where your stop's going to be. And then where does it go? It runs back above the high that was formed prior to you getting stopped out. And then what will happen is you're thinking, okay, well, it was going to just do that. Now it's going to continue to run. And then you'll go into New York, try to buy it there as a continuation, and you're buying the high of the day. And then it trades all the way down, clears out the low that was made at the initial stop out of London low. So now it's made even lower low. And now you're thinking, okay, it's going to break down, or that was the run on stops. So either way you're going to look at this thing, you're going to be wrong. Then it rallies up, goes back in the middle of consolidation. You're thinking, okay, they cleared up the stops one more time. It's probably going to go for the high now. And it won't. It'll retrace deeper, but won't run out the low that's created after taking the stops twice on London. Then it goes in consolidation, and you think the high's priced in. It's not. It comes up and blows out the high, and then it goes into consolidation. It clears the board. It takes all the participants out of the marketplace that are in nearby stop locations. It just kills them, and that's why it's dubbed Seek and Destroy. Seek and Destroy is not my name. It was titled by my mentor George Angel. I used this with S&P profiling. So when I was an S&P trader, this is a lot of times what you would see. Usually you'd get like 1 or 2 of these particular days a month. And there's no real way of knowing when they're absolutely going to occur, outside of the fact that it can occur in the middle of a larger range swing. In other words, it could be in the middle of a consolidation or equilibrium point based on a big price swing. Say if you're looking for a 500 pip move, and say it's already moved like 300 pips or so. That could be the catalyst for this template to occur. It could also occur at the end of a price move, or if you're in, for instance, if we're looking at a buy like we have here, this is an idea we're looking for buy signals or entries. If you are up against or just below layered resistance, say there's a lot of levels that are potentially resistance levels on the daily and or 4-hour chart, this can occur there. Okay, a lot of times, and that's why I don't like to trade when there's a lot of resistance above me. If I see a lot of resistance levels that are layered above where I'm at in current price action, I'm not buying that market. There's just so many opportunities for it to be held down. I'm not interested in trying to guess if it's going to have the steam to get through it. There's so many other pairs to choose from that have open ranges, and that's what we trade in. We trade in where there's a lot of open access to go back into a range that has been not recently traded into. So there's a lot of potential liquidity up there, and if you're bullish, without a doubt the banks are going to want to bring price up to those levels, because that's where they're going to exit or distribute their long positions. So you're pricing in ideally near the low of the day, but this day here is going to kick your ass. It's not going to give you an opportunity to make money. And as soon as you see that phenomenon taking place, do not trade anymore. And I said last night, but I'm not sure if it made it into the recording. But that's the reason why I limit my trades to two a day. Generally, if I make money in London, I'm either managing the position through New York, or if it's so just beautifully set up, I'll do half the risk I had placed on London. I'll use that for New York. But generally, if I lose money in London, I'll go into New York. If I lose one more time in New York, I'm done, because I've learned that this template here is the one that's probably getting ready to knock the shit out of me, and I don't want to risk any more money. I'll usually go to a demo account just to satisfy the desire to want to be right about something, but I'm not putting any more money at risk. So again, this same template can occur in the middle of equilibrium on a larger time frame chart like daily and 4 hour, and that means it goes back to a middle of consolidation. Or if you're in the middle of a larger price swing, you could be in a position that's net profitable. But if you're day trading and doing some additional buying, and you see this price action in here, that's what's happening. It's in the middle of uh, a big battle between the bulls and the bears. Okay, and because that's occurring, the dealers will be sweeping price above and below and above and below. And now they have deep pockets; they can weather all this stuff out. You as a trader, because you need to be nimble, you're risking very little, hopefully, to try to get a maximum amount of gain. Your stop loss is going to be in a very close range from where current price action is, generally, as a day trader. And they know that. So by whipping price up and down like that, it will draw liquidity in or neutralize the open float. The amount of orders that are actually in the marketplace that are controlled with stops, and or they will neutralize pending orders that would bring sellers in or buyers in based on where they are in relationship to the current price. Okay, and trust me, that's all in Precision Trading Concepts and Sniper course on the tutorial page. And I do believe that is it for that. We're going to go over to some live charts, but let me double check on the audio because we've been doing some transitions here. I'm still showing audio coming through on my end, so we're going to keep it going. And we're going to look at cable, and I'm playing around with an idea that was shared with me. Kate and two other people were showing some things to me on how they can plot the central bank dealers range and the flout. So once I get a handle on what they're sharing with me, I will share it with you. But looking at what we got here, we have, this is the cable. Let me take these delineations off. Alright, so what I have here is every day. Let me put the status on. Okay, so every vertical line here, okay, is 4 GMT in this platform. So 4 GMT on this platform is the equivalent to New York in New York at midnight time. Now, before daylight savings time, it was I was always going to 5 GMT, but now it's 4 GMT on this platform. So whenever they do time shifts, it causes problems for my subscribers, not so much for myself, because I allow for deviations in all of my time studies. For instance, like we were talking about earlier with the classic buy template, the idea of being a buyer just in 2 o'clock and 4 o'clock in the morning, while that's great for you as a learning trader, because I'm a little bit more speculative than most and I have the experience behind it, you'll eventually start looking for early signals as early as 1 o'clock in the morning in New York too. But don't worry about that. You'll probably see some of those things occur early on, and that's a test to see, can you still stick with the idea of only trading between 2 o'clock and 4 o'clock in the morning with those premises that we made earlier in this presentation, which I'm not going to go over again here. This is definitely going to be one of those videos you're going to have to go back to a couple different times, because it's 2 decades of information slammed into one presentation. And trust me, I'm like a warehouse of information. We're not even close to me getting to where I really want to take it, but I'm going to be respectful to the amount of time you guys are willing to sit in to get through some of this. So we're going to go about another 30 minutes, and then we're going to close it, because I do want to eat. I haven't eaten anything today. So here's the idea I want you to take a look at. And some of you guys that have been around me for a while know this idea. It's not a new principle. It's what we do here. If we are anticipating bullish prices, Okay, if we're looking for bullish pricing, we're going to be looking for certain templates to unfold. Okay, and we have one here. We're going to just look at the. Let me do the delineations. Just double check. All right, so we have Sunday. Here's Monday's trading. Here's Friday, Thursday, Wednesday, Tuesday. Okay, Tuesday's trading. On Tuesday, this vertical line here. Let me go in here and change this because I really want you to see the separation so we can see what we're looking at, why it makes sense. So that way when you go into your charts, you'll be able to see it and it'll make a lot more sense to you while you're studying. Well, that didn't do much now, did it? Four. Well, let's just take these off, and there you go. The only vertical line you got is that one. And why I went the hard way about that was, I don't know. I'm tired, I guess. So we have midnight each candle. On midnight, you want to get the opening price. Opening price on this candle is 142.40. 142.40. So anything below that price here is a buy, but it has to be 15 to 30 pips below. All right, so I'm going to test your memory. We said if the market is bearish on the dollar, okay, we want to see a buying opportunity in foreign currencies. If dollar's weak, we want to see buys in foreign currency. British pound USD is a foreign currency as a relationship to the dollar. So British pound USD on Tuesday, on Monday, and on Wednesday, we are hunting buying opportunities. We're looking for the price to move minimum 15 pips below the opening price. Okay, it has to move 15 pips below the opening price. What I'm doing here, here's 15 pips right there. Okay, so right here, 15 pips below the opening price. Let me zoom in because it's probably not going to be as tight on here as my recorded videos are usually, because I can zoom in on that. I can't do it here, so I have to really dial in tight. All right, so we have, here is, make sure I do this correctly because I could very easily screw this up and confuse a lot more of you. That's 1 o'clock in the morning. Here is 2 o'clock in the morning, right there. Okay, so that's 2 o'clock. And I'm going to add one more. And if this is the first time seeing this, believe me, your jaw is about to hit the floor. There's 3 o'clock. 4 o'clock. Okay, so now the top of this body of the candle, that's the opening price at midnight in New York. What you're going to do is you're going to block out from that opening price, just draw a line out. Okay, you can do that. I'm doing it by eyeball. I don't need to do it like that, but you can do it on your own charts. Okay, here is 15 pips below the opening price. There's 30 pips below the opening price. My question is, where's the bodies of the candle at? The bulk of the volume in that down move after New York's open is inside of this range. Yes, it wicks down. Okay, on this candle here at 7 GMT or 3 o'clock in the morning in New York time, look at that same candle on your platform. I guarantee you your low is not 41.97. It's going to be different. And that's where there's going to be a disparity from what I show and what you're going to see in your charts. Allow that. You have to permit that area to be inerrant. There's going to be inerrant price action across all the platforms that we trade in. None of us have the exact highs and lows and opening prices. It's not going to be the same. You have to trade in your platform. With these ideas, trust me, it'll get you where you're looking. I'm sorry, it's going to put you in where you're looking to get in at, okay, and help you frame this idea of where you're trying to buy and sell. Now again, this is Tuesday. From this point on here, this is all Tuesday's trading. The platform, I'm sorry, the template we're using to trade for in this idea is we're looking for what to unfold? Weakness in the dollar. It's Tuesday, and because Tuesday has a high likelihood of creating an up day or a large range day, we're going to be looking for 15 to 30 pips below the opening price at midnight. Okay, and once we do that, we're going to buy it right there between these two time windows of 2 o'clock and 4 o'clock in the morning New York time. That's what this is delineating. So inside this box, we have delineated at which we want to be a buyer below. Okay, so in other words, this is what we're saying. The opening price on this candle right there, it has to be below this price. As price is trading down, we're not buying it here. Even though it did this move here, we're not buying it. We're not buying it. Right here, okay, it's going up. But we now started the London Open kill zone for ICT concepts. In there, right at that candle, if I can get this friggin' thing to highlight for me. Oh, good grief. Okay, here's 15 pips right there. It opens here, so it's above the 15-minute threshold. We can't buy yet. And look what it does. It trades up. We can't buy yet. It trades up. We can't buy yet. We're below the opening price in New York. Absolutely. Can't buy yet. Then it starts to roll over. Right here, we can be a buyer. At the minimum, right there, we can be a buyer right there. So watch. We're a buyer there. Your stop loss order's got to be 50 pips below it. There's your stop at the bottom of this range here, or this box, okay, and your entry is here. Notice at no time did I pull up any indicators. All I'm talking about is time and price right now, okay? These are all rules that we just disclosed and talked about, and we're going to use the stop loss. We're going to note that as well. Okay. So adding to the spread 5 pips, we're going to say we averaged in at 142.30, and our stop has to be at 141.80. What's that? 80 or 75, whatever it is. This is the range at which our initial risk is. Okay, and we're going to say that we have bought one standard lot, whatever that is in terms of money to you. It doesn't make a difference. We're just using it as a means of defining the risk. And we're going to look at the daily range, how it unfolds. This is what our initial risk is. Man, I don't know why this thing is acting up. It's pissing me off. We're just going to do it the old school way. This is the part that used to piss people off. Man, ICT, did you know you could do this or that and the other thing with the MT4 and you won't have to worry about doing that? Alright, so we're going to show the reward potential on that initial risk, just on this one particular day here. Now what I'm doing is I'm expanding just to show that same measure of risk being applied in potential reward. And I'm going to combine that with time. All right, so this next vertical line here, this is at 8 or 4 o'clock in the morning in New York time, 5 o'clock, 6, 7, 8, 9, 10. There's 10 o'clock in the morning. Okay, 10 o'clock in the morning to 11, 12. There's 12 right there. It's 10 o'clock to 12 o'clock in the afternoon or morning, New York time. If you're getting out between 10 o'clock and noon, or taking profit, taking something out, okay, the low end of that objective, taking, or worst case scenario you took profit at, was at 42.62. So you're entering, you got about 32 pips of profit if you've banked something there. If you banked something there and you just relax and you don't do anything else. If you are holding as a day trade, okay, look at where we came from. We had a range here, we consolidated, we dipped down below it. Prices only moved a little bit above this old high. So we understand there's going to be a lot more upside objectives to be had. Also, note that if you look at the recordings I had, I called 140. No, it didn't. No, it didn't. I didn't call 140 something. I said that we would probably sweep the high on cable, but we'd have upside objectives still on fiber and cable. So we're looking for advancement or expansion on the upside. In here, you got best case scenario of 32 pips on the first profit objective if you just taking profit between 10 o'clock and noon New York time. The risk, you know what? I really messed this one up. I was copying the range, but it wasn't completely on there. So these aren't enough deviations. Let's go back and fix that. There we are. So we have 1, 2. So there's two reward to risk of 1. That scenario right there. By 10 o'clock in the morning, we really don't have it. We don't have it. We got just in the vicinity of it here. Didn't even make a 2-to-1 yet. The upside for cable and fiber were still on the cards for possibility, and we had weakness going into the dollar. So the scenarios that we were describing in this presentation are still there. But notice what we did. We only came above this high rate in here just by a little bit, and it consolidated and wound up and then released. I'm going to ask you to go back and look at the economic calendar for last week and line up those high impact releases and look at the time of day they were released. Okay, look at those things and also factor in the templates that we described and the time of day and when they occur. And you're going to see on Tuesday we had late afternoon announcements. Okay, right here. There's noon. And then we had expansion here. And on the day, here's 1 and here's 2 o'clock. You want to be out by 2 o'clock. Again, these are all notes that I just gave you at the beginning and middle of this presentation. So we have, usually the high or low is formed on the day if it's bullish between 10 o'clock and noon. Most of the time I'm usually looking for it between 10 o'clock and 11 o'clock. I want to be getting out ahead of it. Okay, so I'm basically sacrificing a little bit of the daily range before everyone else is trying to get out near the high today, I want to be getting out as the price is sliding into there. I don't want to be trying to get the very top pip. I don't care about that. If you do this type of thing, you're going to end up asking for more than you're going to be served, and you're going to end up getting hurt and giving up a lot of the unrealized profit that's open in your trade. You'll see it erode and go back down to closer to where your entry price point is, and that's not fun. But when you're holding for the day, you allow for, like I said, the later stages in the day. You want to see the range to expand. Okay, we're going to show all this in here, how we can look for upside objectives here in a minute. But for now, understand by submitting to time, allowing the daily range to unfold, and you want to be out by 2 o'clock in the afternoon New York time, and that's delineated over here. Okay, the very high of the day comes in the very next candle right here, and we don't really get the very 1, 2, 3, 4. We don't get a 4-to-1 setup for this risk to reward idea here, but we certainly do get 3-to-1. Okay, and you can do very well at 3-to-1. We're going to keep that in check right here. The next day, so here's a classic. This is a classic buy day. Is what that is. That's basically what I'm trying to say to you. So here's the rules. It went down, does exactly what we were saying to do, using a 50 pip stop loss. That's what would be seen here, and I'm going to go into it now and give you the higher form of trading inside this range in here, from this low up to this high. I teach this as a fair value level. The reason why it's a fair value level is because price has ran so fast, it didn't give a lot of opportunity for these prices to be traded in here. See how this is a big range candle here, this is a big range candle here. Each candle is a 15-minute time frame. So it's covering a lot of ground in those 2 candles, or 30 minutes. It's covered a lot of ground. We have a low of 41.75 and a high of 42.31. Okay, so we have about 50 pips in just 30 minutes. That's a lot in just a small time period. So what we're going to do is we're going to actually go in and highlight this. So I'm going to give you an example of how you can refine your entry and not have to take a 50 pip stop loss. Okay, so in here, in this little range, good grief. We're going to say inside this orange box, okay, once we drop down into a 5-minute time frame, we're going to look at this little area down in here that we've highlighted. So we're going to highlight that small section of time, which is the London kill zone, or the time between 2 o'clock and 4 o'clock in the morning that we would look for buys. We're going to look inside that same range here, all in here, and see if there's anything in here that I teach that you use to fine-tune your entry. This is a 15-minute time frame. You can drop down, and once you understand what you're looking for, you can drop down into a smaller time frame, 5-minute. So here's that orange box that we just had. Okay, we like to buy at down candles right before the big move. The down candle right before the big move is where banks and institutions buy. They buy when it goes down. So right in here, we note the high of that candle, or the body of the candle. Right in here, that's influential now. Okay, so if price could trade to that level, or deep, not deep, but just below it, about halfway point of that candle, that's a really good area where banks will buy. Why am I saying that? Because they've shown a willingness to do it here. Okay, retail doesn't move price, banks do. Here's that same blue area we refined. In that same blue area, that's the kill zone between 2 o'clock and 4 o'clock in the morning. Price trades down and hits that level at 142.04. So now we can say we're buying 5 pips above that level, or on a limit. So if it trades to 142.04, a limit order placed with 5 pips above it would place us at 142.09. We can round that to a round number of 142.10. So we're going to say, for sake of example, 42.10. That's our entry, and we'll just put it as a green line. We'll just have it like that so we can delineate it. And that's probably not very clear, but we'll highlight it when I need to show it to you. So price trades down, hits that level. Look at the reaction in here. See that? How much farther did it go below that level? The low comes in at 41.97. The level comes in at 42.04. 7 pips it went down below it. Okay? So if we're going to buy here, if you want to use a refined stop, and you're not buying up here now, okay, you're not just going to buy on willy-nilly between 15 to 30 pips and rate between 2 o'clock and 4 o'clock in the morning New York time, you can wait to see if it reaches down into this liquidity point right here. This is the ICT bullish order block. And if you're new, trust me, it looks like I'm form fitting, but it's not. I've got folks that traded this same trade. I can tell you where it's at in all my teaching. It's all my material. You'll see it happen. You'll hear me talking about it. If you're new, you'll hear still examples of this going forward. It never changes. The same type of stuff. But if you're going to buy here at this level, you're not buying it up here at 42.30 or 42.25. You're way down here at 42.10, expecting it to bounce off of this level. Now watch what you can do now. This stop range now can be changed and refined to that. There's 30 pips. You only had 7 pips drawdown, so your stop is way down here. Okay? So now let's see what that does in terms of risk to reward. And again, this is the reason why I said risk to reward is a myth. It's nothing. I mean, the market and your positions, good grief, is always changing. It's dynamic. So while you may have initial risk, once the trade moves into profitability, which is what everybody's goal is, you want to see your trade go into profitability. So once it does that, aren't you really changing the risk to reward ratio anyway when you trail your stop loss or reduce the risk? So it's a facade. So relinquish the idea that you have to have the full profit because you took a full risk on initially. Because believe me, if you're managing your trade, that's changing as you go on throughout the process of managing it. Those parameters don't stay static throughout the whole life of that trade, or they shouldn't. They shouldn't ideally. You should be effectively reducing the risk as the trade pans out. Now, these are all conceptualized principles here of just giving reward to risk ideas and how the trades would pan out. And let me do this here. So again, we have 3-to-1 set up here. Once it trades into here, we are in the window at the top of this rectangle or square, right in here. It gives you the exit right here for 3-to-1, right there on this candle. It trades down, consolidates one more time. And then what is it doing? It's giving you a continuation at the middle of the range on the daily candle. And you're going to see expansion on the upside, which will show all this business up here in a minute. I'm OCD, guys. Sorry, I can't have that. It drives me nuts. So we're looking for the potential to see higher prices. And if it goes higher, and say we hold for the 2 o'clock hour, because we have news being released later in the day after the London close. 1, 2, 3, 4, 5, 6-to-1 reward to risk ideas. Okay, and it pays you that going into the 2 o'clock hour here. Now watch. When we go into the next trading day, we moved a great deal here. Okay, and we moved up into a higher level resistance point, another bearish order block. So we have a new trading day. The market goes up, makes a high today, comes back down, gives you continuation, runs up one more time, and now we have a market reversal profile. Or New York open, London close, market reversal. Look at that template and you'll see that's what's happening here. Then you see we have the London swing to consolidation, or Z-Day, which is what this is on Thursday. Nice little rally on London. goes in consolidation, and there it is. If it happens on the heels of a market reversal profile here, or New York open or London close reversal, because we take out the low in London and we have a Z-day format or template on the next day following it, we've priced in a swing high. So the next day is going to be a candidate to be a short seller. So you got to be real careful about being a buyer on that day. If you are going to be a buyer, you need to be very short in terms of your risk. Don't be a lot heavily leveraged on those days. I want you to take a look at the scenario here. Here's the opening price or thereabouts on this day. As a buyer, 15 and 30 pips below it, be a buyer. Take out a previous low, boom, it rallies. In here, it starts right out the gate. It doesn't give you an opportunity to be a buyer again until here. So you may not have gotten this, but it does give you a nice return into the range here, and it runs up, takes out the high, London close reversal, or New York open or London close reversal template. And then it comes down and clears up the lows that are formed in London open, just like the template describes. On this day here, we have the reverse. We have the open, and then it rallies up, creating the high of the day, which would be a classic sell day. And then it comes down, gives you another opportunity to go short in the middle of the range, and then expands down to the downside. Today, we had market trade down into in a 5-minute chart. Let me get out of that. We have a 5-minute chart here, and forget all this over here. We'll come back to that in a minute. Going into today, we saw price do what? It trades down after this is New York at midnight time frame. The opening price is 142.23. So 15 to 30 pips below it. I'm just going to eyeball it, guys. Okay, right there. So the top of the box here, that's where you'd be a buyer minimum price wise. It has to go at least down there. And 30 pips lower would be here. Okay, so we're looking for that much of a deviation below the opening price as a filter. As a trader, understanding the principles I use and teach, if you look at a hourly chart, down candle prior to the up move, bullish order block. Okay, what you're going to do is you're going to highlight the top of the candle. This is all in precision trading and sniper trading tutorial on my website for the folks that are new. So believe me, I know it looks like I'm doing a lot of lipstick here, but I promise you it's all in the notes. And actually I can show you one of our subscribers that actually sent me this 9, or actually longer than that now, 12 hours ago, before the fact that this was the level where he was reaching up to here, which I'm very proud of, by the way. Troy, you did a good job calling this. But we have excuse me, here's midnight, 1, 2 o'clock, ready for it, 3, 4 o'clock in the morning. So there's our time window. So between these two vertical lines, let me zoom in a little bit more. Between these two vertical lines, we have this range. It has to trade down into this minimum, and it can go as deep as this. But look what we did. We trade back down to a bullish order block here. So this is overlapping in here. So this is what we're doing. We're looking for a confluence of ideas to support institutional sponsorship behind the trades. Okay, we have a high in here where liquidity would be resting. Okay, so we have bullish order, bullish candle here, which is the bearish order block, and the high after it, there's liquidity above it. And we also have a range here, which starts really at this candle here, even though we have this one. So we have two back-to-back candles. This is a 1 hour chart. This would be represented as a bearish order block on a 2 hour chart, which this time frame doesn't really give us. And if we look at that in the form of, if it was a 2 hour chart, that's how your bearish order block would look. So MT4 limits me in my perspective of sharing that information, but I tossed that in here now for continuity. You can see that's what a 2 hour bearish order block on time would be. Time is time. You can't negate other time frames just because I don't show it on my presentations. But 2 candles up prior to this big move, that's a 2 hour bearish order block right there. So this is where the top of the range may reach for. The high on this candle, 143.24. The high of the day is 143.25. So we did run into that liquidity pool here. We just ran into it just a little bit. I do suspect we're going higher though, nonetheless. Now, with all that said, this is a classic ICT buy profile. Okay, down after that. Why is it like that? Because we see price trading into a bullish order block here on Friday. We noted that in conversation, I think, on one of the videos. So Friday we traded down into that order block, okay, and it wanted to rally, and if it's going to be bullish and we have some weakness in dollar, trade back down into this bullish order block here. Time of day between 2 o'clock and 4 o'clock in the morning. We're going to buy how many pips below the opening price of midnight opening in New York? It's going to be 15 minimum, up to 30 pips below. Well, we're looking for that range to line up with something else institutionally. And then look what happens. It explodes up and over 100 pips price move today. Let's take a look at we have today. This is that same price action. This was that last Tuesday's trading day here, okay? And we're going to show you how projecting the daily range on the algos at the bank level, this is the precision you end up getting after you learn all the stuff I teach. We're bullish on the day, okay, on Tuesday. So we're going to be looking for protractionary states on the daily range that create higher pricing intraday with a higher close, okay? And we're going to use ranges that I teach you. This is one that starts it, and it got one deviation down. It goes just a little bit below it. You got one deviation above it, 2, 3, 4, 5. Nails it to the pip. Why is this important? Because it's time overlaid with the ranges being projected on one side of the market. We're bullish. We're only trying to capture the high of the day. How far can the daily range expand to? When you couple that with time and the ranges, that's how you nail down the high of the day. Okay, and you'll allow for time to expand. Okay. Same thing here. 1, 2, 3. 2 deviations above. Only look for it 1 to 2 deviations on a reversal New York Open or London close scenario. That's generally what you'll get. Nails it to the pip. I think it went like I have a pip above it and then ultimately rolled over. We have last Thursday we had a London swing to Z day. It's generally going to be 1 deviation above on the information that I teach with these ranges, which I'm not going to go into here because I'm trying to avoid a lot of additional questions that I'm going to get on Twitter. You're just going to have to wait for all the material to be presented. It's all in market maker stuff that's being released. We have a bearish order block here. Trades right up into it here. We also have the projections. It just fell short of it, which is nice because it gives you an example how it can be a little bit off. And this is why I say the highs and the lows on all the platforms are going to be different. And if you look at the high on your platform for this particular time, it's March 31st at 11 GMT for Forex LTD's platform. That's the high, 144.30. So I'm guaranteeing yours are all going to be different from that. Some might be higher, some might be lower. And then on Friday, non-farm payroll, we have the range projected 1, 2, 3 for a classic sell day profile. And it trades down into, this is the projected low, but it ultimately reaches down to where the institutional sponsorship is, which is this bearish candle or bullish order block. So it closes in this range of fair value, nails it to the pip. And now, because it's fulfilled that, and where overall context is still bullish fiber and cable, bearish dollar, until we see otherwise indications that dollar wants to rally where it's at, we have to stick with that pattern. Being nimble, being a buyer, but still nonetheless looking for reasons for it to want to pop higher. Monday, here we go. We have the scenario. Monday, Tuesday, or Wednesday being a buyer. Look for 15 to 30 pips below it. Here's the range. One deviation down. It takes you right into the bearish candle, which is the bullish order block. Deviations. Classic buy. It's going to be 3 deviations up. If one's down, sets the daily range. It's 1, 2. 3. So here's 1 down, 3 up, classic buy day. This is the projected range high you would look for. It can reach one more time on setups like this, and that's the bottom of that 2-hour bearish order block. The bottom of the up candles in here prior to this big sweep down price. If you extend that out in time, very close proximity to that for that. So we could have easily projected up into this level here, but generally you're going to see on classic days like this, it's going to be, if it's 1 down to create the low, it's going to be 3 up to post the high of the day, and the algos will reach for that level for liquidity. Big runoff and explosive days like this one over here, okay, you just got to keep adding more of the ranges until we reach time of day. What time of day is that? 10 o'clock to noon in New York time, okay, and if it still has a lot of range to unfold, and if there's news later in the afternoon, it will move farther than just what you probably have in 3 or 4 ranges added to the initial one that sets the daily range. And these are all going to be explained obviously in the last video of my presentation for Market Maker 12 content. And once that's done, I get a lot of the initial ideas and questions presented to me. Then I'll be able to go into a very refined presentation that you've seen with all the other videos on my tutorial page. But this stuff is a lot of information, and I know I'm going to get a lot of questions about it. So if I can field those questions before I make the final cut, hopefully the presentation will be a lot more, in my opinion, hopefully complete. It doesn't mean you're going to know everything the first time you watch it, but at least it'll save me a lot of emails, because right now I'm over 4,000 and some. I just can't keep up with the influx. And I think that's it for that one. Let's take a look at Euro real quick. Alright, so we have Euro gave on Friday, it gave a London swing and then reversal to Z-Day in here. So this is basically Friday's scenario in fiber was Thursday's trading in cable. So we had an initial run up like we did in cable on last Thursday, and then it rejected and moved into consolidation. Friday, later, 1 day later, fiber does the same thing. It runs up and then goes back and sinks. So that's what I'm saying. Whatever the leader is between correlated pairs, then the one that didn't do it will eventually do it in a short time period afterwards. Now we are in consolidation. Now we have the same thing happening on Monday. So now, without even looking at it yet, we saw cable rally and euro dollar is in consolidation. We've not made a higher high. We've only come off the London low off of a bullish order block in here, but it didn't make a higher high here. See that? So we have a London swing to consolidation or Z-Day, and this right here is indicating what for euro pound. Without even looking at it, I haven't even looked at it all day. What do you think the euro pound is doing? I mean, obviously you have the those that are here live have the advantage of just clicking on their chart and seeing it. But if you haven't been paying attention to it and you haven't looked at your charts yet, what would you think is indicative of what you're seeing here with the euro in consolidation and cable being permitted to rally like it did here today? What do you think's happened? Euro pound should be what? Down. This is the daily chart. I'm going to go into a 15-minute time frame for today. Down. Bullish order block. I'm sorry, bullish candle. What's the bearish order block prior to this move down? It retrades back into it. This candle here is 9 GMT. It's inside the London kill zone. Boom. Trades down into excuse me. Trades down into a bullish order block here. And let's take a look at the dollar. Dollar's still inside our little area of interest. We're really watching to see what it wants to do here. It's not made any measurable move, any conviction above or below it. Given what we have here, to me, it looks like it wants to go down through this. That's what it looks like to me. Obviously, it could change gears and roll right on up here Tuesday and Wednesday, but I just don't think that's what it's indicating here. There's a lot of wicks and indecisive price action. So, like I said, this until this is closed below and really makes a convicted move below it, 94.34. Um, to me, I think it's going lower. I think it's going to do that, but unless we get out of this and trade back above this level here, this low, 95.27, I'm still bearish dollar near term, even though I have a longer term bullish aspect on the dollar. I do suspect that we're probably going to sweep out this low, given what we have here now. Now, obviously, that can change on a dime, but nonetheless, that's what I'm seeing. Just go back to cable for a minute. This one here could be a distribution area for a larger market maker sell profile. Okay, so in other words, if we're looking at price like this, okay, we have consolidation, accumulation, smart money reversal, low risk short, redistribution, another redistribution area, and we can come back down and work within this larger consolidation here. And ultimately, we have liquidity below this low here, and we have liquidity below this low here that has not been traded to extend that out in time. So for the bears, that's what I would see unfolding if we start to break down from this run up. If we consolidate in here, that gives room for Euro USD to continue on the upside. I would not want to see this area of liquidity taken out any more the rest of this week if it's going to be for the bulls. So this is going to be influential in my opinion. I think that price needs to stay above what you see here. Okay, can it dip down in here as a run-on price? And as long as it does that and rejects immediately, then you got a green light go. It's going to go higher. Fiber will probably trade up into the 115s if that scenario unfolds. And again, assuming the dollar stays where it's at in its range on the daily chart or breaks down further, that gives us a clear shot for the 115s for fiber for this week. Other than that, if we see the dollar rally from where it's at on the daily chart, that sets the stage for a breakdown eventually on euro and cable, and which one leads the pack, obviously, and that will set the tone for the rest of the week. So it's a watch and see, wait and see type thing right now because we are at a major area of support. and I don't know if that level is going to give way or if it's going to maintain. And that's one of the things you have to wait through, and you have to see if it's going to have any strength to get through it. If it doesn't and rejects, we have our directional premise. We'll trade back up into this range here. If it breaks down and shows an unwillingness to go back above the middle point of that down candle, which is what we have highlighted here for 94.34, we would be looking for further continuation for dollar to break down and clear out this low, which would give upside for foreign currencies. So that is it, kiddos. We've had a long one today, very, very long one. But hopefully you guys have seen. Actually, you know what? Let me give you one more example. Thought you were getting away easy, didn't you? Give me one more example of the classic buy scenario. Last Tuesday, same thing, same premise. We had the fiber create a buying opportunity, 15-30 pips below the opening, comes down into that nice opportunity to be a buyer, another buying opportunity here, and expands to the upside. Okay, on Tuesday. On Wednesday, same scenario. We have a buying opportunity, rallies up, close higher on the day. Thursday, same thing. We have a market trades down after the opening on midnight, and then rallies up into a higher close on the day. This delineation is 0 GMT, so when I say it's moving lower, you have to break down the actual midnight candle in each one of these days. On Monday, the same scenario here unfolds. We have the market trade down after midnight in New York. 15 to 30 pips is our filter. Trades down here, hits it, and rallies up close. So when you're bullish, you're looking for a move dropping down initially after midnight to set up buy scenarios. Don't chase price. Don't think it's going to roll over and keep going down. It has to go down to draw in sellers so that way they can be on the counterparty of that and be buyers. And that's how it works, guys. It just repeats itself over and over and over again. When the scenario is that the dollar's bullish, fiber will give rallies up, and then you can sell into that and rolls down. Rallies up, sell into that, it rolls down. Rallies up, sell into it, it goes down. Rallies up, sell into it, it goes down. And when the dollar is bearish, as it were during the week of the 14th of March to the 18th, okay, here we go. We have Wednesday's trading. London close reversal profile, rallies up, does well beyond the London open high, and then next day we have market reaching for higher prices as we indicated it would do when we talked about that particular template, and rallies up and creates a nice move here. Again, Tuesday creating the buying opportunity. I'm sorry, Wednesday presenting the buying opportunity. If you're bullish, it's Monday, Tuesday the best, Wednesday if it doesn't rally on Tuesday or Monday. Wednesday's the last ditch opportunity for a rally, and you get it there. Interest rate driven event there. They can really mess up weekly ranges. Another opportunity here is Monday. Rally up, sells off, creates another dip down in here. Wednesday, buying opportunity, hold for the week. You can use short-term entry patterns based on everything I've shared here in the templates. All that can be applicable to this, and that's what I want you to do. I want you to go through the marketplace each day, map out every single day, and define what they were based on those 6 templates that I just shared with you. And by doing that, when we go into our teaching next or this coming Sunday, I'll actually give you criteria that helped build in the expectancy for each one of those templates to unfold, which will give you a greater understanding of what you're going to see for daily daily range engineering, where they make the high and low of the day and where they're going to reach for. And the part I'm still working on is if it's going to be a buy day, how I can systematically define both ends of the range. And sometimes I can do it, but sometimes I can't. Most of the time I can't do that, but usually I'm right on the direction and I'm right real near the high of the day, but I'm still fine-tuning that really perfect entry where I can define it by a rule-based idea well beyond what I've already shared here today. So I'm going to wish you guys a very pleasant afternoon. I appreciate you spending all this time with me. It's been a long one. We've been at it for longer than 3 hours, so I'm going to wrap it here and give you guys an opportunity to digest it. And wish you good luck and good trading.